early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think Europe's falling into a recession. It's got a tightening central bank now for the first time in a very long time.
Really, it is going to come down to, do we see those high inflation prints? Do we see those hawkish comments?
There's a very narrow path between an inflation problem or a growth problem.
The low-end consumer is really feeling the pinch of these higher gas prices and higher food prices.
I think you could see a bear market rally, and I'm going to say that it's a bear market rally rather than a full-on rally.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on a most important, a consequential day for global Wall Street on inflation. Matthew Miller in for John Ferro this morning. That is a good and beautiful thing. Red and green on the screen. But Lisa, look at the sell-off in equities yesterday in preparation for 90 minutes from now.
In preparation for higher short-term yields, period, full stop. Whether it's in the United States, whether it's in Europe, the trajectory is up. It doesn't seem like there is anything to create a pause. And today's data may just confirm that, Tom.
Legit curve flattening, and there are some people writing about new curve inversion where the 2-year yield, that Fed yield, is above the 10-year yield at yesterday. But Lisa, yesterday with a vengeance off weak euro, we saw a curve flattening.
And we continue to see it this morning. You're seeing the ongoing inversion and a deeper inversion in the 5-10 spread, the 7-10 spread. I'm not going to bore you with different numbers.
Please.
The idea here is, no, I do it every day. Why
Let's
stop now?
The show. It's an inflation report. Things are incredibly important. How about that auction yesterday?
It was actually really important, and I'll tell you how this links into inflation. The hotter inflation is now, and the more it persists, what it means is people projecting slower growth and a harder landing. And that is what we saw with bids coming in for 30-year bonds. People want duration in a pinch, and that is what we're seeing, Tom, as people project forward not only the Fed, but inflation itself and what that does to economic growth.
The only auction Matt Miller cares about is when he's out there with 10 gazillion used cars looking for a Barracuda slant 6 from another time in place. Matt Miller, used cars, maybe they're ebbing, other things aren't in inflation.
Yeah, first of all, I would give an arm for a CUDA, for sure. But look, people talk about inflation and they talk about inventories a lot lately. Cathie Wood said we should be more worried about deflation than inflation, although, of course, she's seen the biggest outflows of any ETF this year, any family of ETFs at least. We're still seeing extreme shortages in anything that needs chips and anything that needs commodity inputs like cars, like washing machines. So household durable goods and vehicles still aren't on the lots.
I want to exit now to a vignette on international relations into the weekend. Some of the mysteries for Europe in this war in Ukraine. Mr. Putin, after the Bank of Russia this morning moved rates back to a pre-war level, is meeting with the new leadership of Turkmenistan. This is very, very important, far out on his southern and eastern front as well, but it gives all, and particularly for those of you on Bloomberg Radio, an update on the concerns about Mr. Putin's health. People are looking at this daily, certainly weekly, as they gauge the health of Mr. Putin. We simply give you the images without comment. Lisa, I think we've got to get to a morning brief, and it's got to center around this 8:30 report.
Yeah, well, let's get a sense first of what's going on in markets. We can see a decline across the board. Earlier in the morning, we saw a bifurcation between the S&P and NASDAQ that is persisting, which is interesting given the safe haven trade that we are seeing. Euro continuing to depreciate. This is fascinating. To your point earlier, Tom, it is now below a 106 handle. We have a 105 handle on the euro. I sound like I'm auctioning it off. This is the issue. The ECB came out yesterday what some people viewed as a hawkish message, not translating as such today as we expect that hot number perhaps from inflation. And then 10-year yields lower. Interesting, because the short-term yield is higher, that curve flattening. Really, the key point today is going to be 8:30 a.m. as we've been talking about the key data point of the week, possibly the month and beyond. How much do we see a deceleration in inflation when you strip away energy, when you strip away food? Do we see the expected decline from 6.2% to 5.9% in May as people were expecting? Does this matter? And this is where I really think perhaps the bigger number will come into play. Real wages have declined deeper and deeper into negative territory. Basically, the American budget is declining when you adjust it for inflation at a dramatic pace. The wages are not keeping pace with inflation, and that's leading to a deterioration in consumer sentiment. 10 a.m., we get that number. University of Michigan May U.S. Consumer Sentiment Survey data comes out. We have seen it fall to the weakest going back to 2011. The expectation is for it to continue in this way. And at 1:45 p.m., President Biden will attempt to address the concerns that people are feeling, addressing supply chain issues at the Port of Los Angeles. How much can he do, Tom, given the concerns and given some of the exogenous factors, whether it's China or whether it's Russia's war in Ukraine?
Late in this hour, as he wakes up early in Los Angeles, Ed Ludlow will join us traveling with the president. Now is a wonderful time to speak to Jane Foley with Rabobank and with all their commercial affairs in business. She is their head of foreign exchange strategy. I've got to go to the pair relationship, Jane, and the partial differentials now. In the last 24 hours, is the dollar stronger or the euro weaker?
You know what, I think we've got a weaker euro here. And on that side, you might think, well, that's a bit strange. The ECB were very, very clear, much clearer than normal in their hawkish message, telling us they're going to hike interest rates by 25 basis points in July and leaving that door wide open for a 50 basis points move in September. But I think the message here is what they didn't say. And of course, there's a new word associated with Europe and the ECB now, and that's fragmentation. We had press reports during the last few days which said that the ECB would give us some clearer messages about what they would do to stop those peripheral spreads, bond yield spreads from widening. And they did not. In fact, Lagarde was really quite evasive that there wasn't much in that. And so the message was, you know what, they're going to carry on hiking, and actually they're not prepared to do an awful lot to stop those spreads widening. And that is a concern for investors. That's a concern about the outlook for the European project. Well, and until we have more message on that front, I think the euro looks a bit vulnerable.
Jane, this is exactly the point, the existential threat of a peripheral region that is in a world of hurt, even as the core manages to deal with the inflationary headwinds. At what point, at what spread, at what yields do you start to get the most concerned about the euro project? Do you start to see a more material weakness and more discussions of parity with the euro and the dollar?
Well, you know, if we really were concerned about, real fragmentation, yes, I think we would be talking about parity. Perhaps it's a little bit early. Now, Lagarde, it is likely that the ECB and Lagarde will come up with something perhaps in the next few months. If they don't, the market's going to be really concerned. But then, of course, we've got to look at the economics here. You know, how risky are the economics here? You know, is Italy really in a position where its debt can blow up? And then there are, of course, lots of other factors that would have come into play for that to happen. And not least, of course, is the price of gas. Now, certainly, if Europe were to announce a full embargo on Russian gas by the end of the year, that would create additional stresses. So we would have to have, a lot of other factors coming together before we got really, really worried. But for now, the fact that the ECB appears to be stepping back from its support of bonds in the periphery is certainly a concern.
In terms of what we would see in terms of what do we call it? Fragmentation. Don't you think that the ECB sort of showed their lack of tools yesterday? What could they do to fight inflation if they're so worried about fragmentation?
Well, again, we were expecting, or we had seen some press reports that they would come up with some other fund that they could use to buy these peripheral bonds if the concerns about fragmentation really became strong. Now, the likelihood is that just the fact that this fund existed could be enough to reassure investors and to keep those yield spreads in. So I think that's what the market will be looking for, over the next couple of meetings, hopefully by July. I mean, we really need to hear that they are working to put this together, and a little bit more guidance on that front is what investors need. But of course, the fact is that they are worried about inflation. Lagarde made that clear, that she sees second-order price effects coming through into the Eurozone. That means they do need to be hawkish. So it's a case of a bit of balance here from the ECB.
Jane, very quickly here, I see BBDXY, the Bloomberg Dollar Index, a better index, a broader index, 1.4 standard deviations off the full trading partner DXY index. What does this inflation report mean today for the broader emerging markets?
Well, for the broader emerging markets, of course, they're really, really sensitive to what the Fed could or could not do in terms of interest rates. More interest rate hikes from the Fed, more aggressive pace of interest rate hikes, really bad for emerging markets. And I think this is what the CPI index will help us know. We need to know, have we reached this peak inflation scenario yet or not? And then, of course, we need to look through the curve, look at, again, at some of the factors that you were just talking about. How hard is the inflation really affecting consumer and consumer confidence? Is it meaning that people are spending less at this point?
That gets us on to our next conversation. Jane Foley, thank you so much, with Rabobank. And Lisa, this goes to what Ms. Foley and you were talking about, which is it's not just the 8:30 report, but it's from Ann Arbor in the University of Michigan report here. I'm looking out in the one data point, Lisa, 5 years out, and then 5 years out from that, the inflation guesstimate.
How sticky is it? How intractable will this become in terms of inflation expectations that become a self-fulfilling prophecy? And then in the nearer term, how self-fulfilling does a recession become if consumer sentiment starts to wane dramatically? If people feel terrible and consumers account for 70% of the U.S. economy, that becomes a serious economic problem, Tom. And that is the reason why people watch this so closely.
And now we go philosophical, folks, which Lisa, I can do after we've had the morning tang. Lisa, is high inflation good for the banks?
Wow, that's a really deep question. Ostensibly, it could be if rates are higher and demand is increasing and real wages are increasing.
Nailed it.
But right now, that's not happening. And because of that, it could become a headwind, especially as growth concerns start to
critical, if we go from 8% back to what percent do we finally get demand to come back in and recession fears to ebb? We will have to see. This is interesting, to say the least. Roughly 1 hour from the most consequential inflation report in ages. This is Bloomberg.
Keeping you up to date with news from around the world with The First Word, I'm Ritika Gupta. The Biden administration is trying to avert another inflation-spawning logjam at the nation's busiest seaport. President Biden will visit the port of Los Angeles today. The White House is closely watching talks on a new union contract for 22,000 West Coast dock workers. A collapse of the negotiations risks a work stoppage that would snarl U.S. supply chains still suffering pandemic disruptions. U.S. Defense Secretary Lloyd Austin met his Chinese counterpart on the sidelines of a major Asian security forum in Singapore today, where both countries are pressing their competing visions for regional stability. The U.S. is hoping to use the forum to establish guardrails to prevent competition from getting out of hand. The meeting comes as the war in Ukraine consumes Washington's attention and Beijing struggles with economic pressures at home. Shanghai will briefly lock down nearly all of the city's 25 million residents this weekend for mass testing as COVID-19 cases continue to emerge. The flare-up is causing more disruption and triggering a renewed run on groceries just days after the city exited a 2-month shutdown. Health officials are testing to root out any silent transmission of the virus, a key tool in China's COVID-0 arsenal. And Amazon doesn't want to get into a bidding war for the rights to stream Indian Premier League cricket matches. Bloomberg has learned the company plans to withdraw from a heated competition for one of the world's most popular sporting contests. The surprise move leaves the field open to Ambani's Reliance, Disney, and Sony. The rights had been estimated to fetch an unprecedented $7.7 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
What
worries me, John, and you're not going to like this because it's looking forward. The June month-on-month print will be worse than the May month-on-month print. I think those who boldly said inflation has peaked and it's coming down may have to change their minds.
Mohamed El-Erian on another property yesterday for Bloomberg Television. We're thrilled that he could join us. Television and radio, I should say as well, talking about the path forward on an inflation report. Lisa Bramwitz and Tom Keene. John Farrow's off today. Matthew Miller darkens the door, which is a good thing as well. And Joe Matthew returns after a discussion in the last hour of the January 6 hearings that we saw last night. Joe Matthew, I want to take the chairman of the hearings, Mr. Thompson of Mississippi, and bring it over to the inflation report. We are hugely skewed to 3 zip codes in New York and maybe 2 zip codes in Washington. Mr. Thompson of Bolton, Mississippi, out I-20 west of Jackson, Mississippi, is looking at rents go up and up and up. A modest house in Bolton is $600 a month, which is outrageous. Explain for our fancy audience the outrage of your Washington over inflation moving from what appears to be a very low price, but then up substantially.
Yeah, and imagine coming from a town of roughly 500 people, as he described last night, the impact that that would have on the community here. The president's going to get to some of this today, Tom. He's not talking about the January 6th committee, at least not yet. He's scheduled to speak from the Port of L.A., in which he's going to tackle this inflation issue. It's something that he cannot escape on either end of Pennsylvania Avenue. And we'll have some good things to say, apparently, about the supply chain. You remember when there were more than 100 ships lined up. Now there's 20-something ships. But we're also on the threshold of what could be a major strike by 22,000 dock workers, which Bloomberg is reporting on today. So the president could actually be facing that, combined with the reopening China, more bottlenecks in the supply chains. Of course, housing is another component of inflation, and then you've got the energy component. Put those 3 together, and you're going to tell me a story at 8:30 about how bad things are.
And Lisa, what's important here is I'm just by chance looking at Fargo, North Dakota, Lisa. Median rent, $1,045 a month, but up 35% year to date.
A far cry from when I lived there, I've got to say. Back in the early aughts, I have to really take a look at the transformation of some of these regions, Joe. As the Democrats try to paint some sort of ability to combat inflation, what is the message that they're starting to coalesce around? Because there are some.
Yeah, it's become a more deliberate message recently, certainly from the administration. You know, we've always heard about deferring to the Fed, but now when you hear from the president's economic advisors, they delineate between what the administration is doing and can do, and then, of course, the Fed is going to take care of the rest. We're still hearing about the CHIP Act, the Bipartisan Innovation Act, the China Competes Act, whatever you want to call that. It's been stuck on Capitol Hill for a year, and 100 conferees are in the room trying to figure out what to do with that. Then there is this idea of a stripped down, build back better. We started hearing the word reconciliation around here a lot lately because Democrats know, and I think this is where you're going here, Lisa, that they probably only get one more swing at the ball. So you get in a room with Joe Manchin. He's already talked about re-engaging on this and figure out exactly what he and Kyrsten Sinema can approve of, and some would suggest they should have done that a year ago. And it might be, as we creep up on the midterm elections, that Democrats are talking about things like lowering prescription drug costs again, extending the child tax credit, and giving them something, giving Democratic candidates something to talk about on the trail.
Last night at the January 6th hearings, a really notable aspect was a discussion that the U.S. has to get its own house in order to have a credible presence trying to get unity on a global stage. And this comes to both with respect to Russia and Ukraine, but also when it comes to dealing with inflation that is not just isolated to the United States. How much is that what a lot of politicians, both on the Democrat and Republican side, looking for, some sort of international cooperation to push this forward?
Well, look, that would be that is the goal here. The administration likes to remind us on a regular basis that it's a global phenomenon. There's nothing special about American inflation here, that this is something driven by the pandemic, by the war in Ukraine. And the president here in the middle of the Summit of the Americas is trying to take a kind of a whole of government approach with our partners on not just inflation, but also immigration. The problem here is that there are so many stakeholders not at the table at this summit this week that it's impacting the conversation and may water down any kind of a diplomatic or mission statement that comes from this summit. But the president and his economic advisors, including Janet Yellen, the Treasury Secretary, continue to try to frame this as a global phenomenon and not something that's special about America, despite what you're hearing from Kevin McCarthy and Republicans on Capitol Hill.
Joe, one of the issues that the president ran on was the fight against climate change. And Lisa was citing a stat from Berkeley earlier where, like, every time a gallon of gas goes up $1 or 2 or 3% more people ride bicycles. Is anybody in Washington saying this is a good thing, $6 gas? Because we want to stop using fossil fuels.
Well, I know where you're going there. I don't know that anyone's saying it out loud is the problem, because that's just not going to resonate with anyone in a positive way, at least no one the Democratic Party is concerned about on the campaign trail. But there are progressives on Capitol Hill who are concerned at the idea of the Biden administration turning back to oil companies in this country and asking them to drill more. Look, the fact of the matter is these climate provisions have been slowed down by what we're dealing with here. That reconciliation bill I referred to, though, Matt, that Joe Manchin would sign on to will include some climate provisions, whether it's carbon capture or something else that might impact the electric grid has yet to be determined because nothing has been written. But it's something that Democrats hope they can show later this year, that they haven't taken their eye off that ball.
Joe Matthew, thank you so much. Greatly appreciated today. Sound on today, 5 p.m. Lisa, the senator from West Virginia, Mr. Manchin, and again, I think this shows the huge disparity between the rents we look at and others. Charleston, West Virginia, the rent is under $1,000, whatever the number of units. This from Zumper, $775 per month. But still, Lisa, up a painful 35% in that income category.
It's a patchwork of stories, and some of the less urban areas have seen the prices bid up that much more after the migration out of cities during the pandemic. And now as people come back, prices everywhere are going up dramatically. Some of the year-over-year increases really stunning. And the reason why Joe Matthew says that nobody wants to talk about gas prices being perhaps longer term and easier way to move into that transition is because on the lower income side, people are getting hammered by those higher gas prices. It is about the budget, as John Farrow has said, and that budgets do not allow for the price of gas at $5, $6 a gallon and beyond.
Alicia, can we mention that we've had curve flattening this morning as we go into this report after the emotion yesterday afternoon, the big drop in equities. We have a continued movement here on 2s10s from 0.31 down now to 0.17.
Yeah, the more that the Fed does
17
now,
basis points.
How much does that remove growth longer term and reduce the specter of runaway inflation? How much is this basically Fed credibility, some people might say?
Some of the dynamics that we are looking at 1 hour away from a critical inflation report. Coming up in 15 minutes, we go to Long Beach, California. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg surveillance on a most important day, 1 hour away from an absolutely key inflation report. Lisa's going to start out with futures right now, but I'm sorry, Lisa, Euro speaks volumes.
It speaks volumes about the divergence in the pictures for inflation and for growth, both in the U.S. and in Euro. What I'm going to do here is I'm going to first pretend to be John Ferro, and then I'm going to pretend to be Romain Bostic. So pretending to be John Ferro, taking a look at what's moving markets. To me, the interesting note is not the actual magnitude of the moves, because they're not that big, but rather the divergence between S&P and NASDAQ. We have seen for so much of this year the NASDAQ underperform to the most that we've seen going back to the dot-com bubble, the S&P. We are seeing a shift in that as growth concerns start to weigh more heavily. NASDAQ futures up about 0.1%, S&P futures down about 0.1%. Again, not huge moves ahead of this key print, but still notable. A lot of this is being fueled by the bond market. You're getting relief on the long end, a bid into longer dated bonds, the 10-year and the 30-year bond yields coming in a bit, whereas that 2-year yield continuing to climb. Yield curve flattening, 2.86% on that 2-year now, as people expect the Fed to have to be more aggressive with their moves, even as longer-term growth projections come in. And that 30-year really standing out to me after an auction yesterday that was stronger than expected. Yields down 3.15%, Tom. Again, people are gravitating back to duration given what they expect for growth.
Really interesting seeing, as Dr. Alarian mentioned here, Lisa, this idea of looking out to the second, the third, the fourth inflation report from now is really key.
Right, and so that's why each prospective report becomes increasingly important, not only for the U.S., but also for the Euro region. Yesterday, the ECB came out indicating they were going to hike rates at the next meeting, leaving a 50 basis point rate hike on the table. They are ending their bond purchases, and you get this. Weakness in the euro and continuing to be even weaker against the dollar as the session goes on, 105.83 against the dollar. How much does this have to do with a lack of commitment to immediate and urgent movement by the ECB? And how much does this have to do with what Jay Foley was talking about? To me, Tom, I think this is the key issue. An existential threat to the euro project, given the fact that peripheral spreads are starting to blow out, and you might see that continue because there is no concrete plan. I do think that we're going to be talking about that more frequently. Right now, I'm going to pretend to be Romain Bostic and get you some movers. I'm going to just whip through this really quickly. To me, Credit Suisse nearing the lowest levels that we've seen in decades. People talk about possible combination with State Street, them saying it's nonsense. The share is now $6.42. It speaks volume. And Twitter shares, I'm watching also closely. We haven't really been talking about this, Tom, but they came out and called Elon Musk's bluff. They basically said, okay, you want all this data on all of the spam? Here, you can have it, but you can't use this as an excuse to avoid $1
billion breakup fee. And then I just wanted to look at the tech sector, to take a look at some of the flight to quality, and that we're seeing that green across the board. Apple, Meta, Facebook, and Microsoft all up, with Meta up 0.6%, 0.7%. Again, flight to safety. This is big tech being a haven yet again, at least on the margins, as people worry about growth concerns, Tom.
Lisa, thank you so much. Joining us now for an exceptionally important interview for those overweight or overhoped on technology, Daniel Suzuki. Dan Suzuki works with Richard Bernstein, Definitive. I can't say enough about Richard Bernstein's classic book, Style Investing. Dan Suzuki, the style has been to own technology. You people are heated that technology is a value trap. Why is it?
I think that's right, Tom. I think, there's a lot of people saying that at this point things have gotten cheaper, and obviously they have, but that's the argument you could have made, 3 months ago, 6 months ago. And by the way, that was the same argument that people were making from the very early stages of the tech bubble back in 2000. I think it always has to come back to the fundamentals, profits, liquidity, and sentiment. Sentiment, from a sentiment valuation perspective, this remains the most expensive and still well-loved, part of the market. Despite the volatility, they're actually seeing inflows in many of these areas of the market. They're probably the biggest beneficiaries of the liquidity boom you've seen over the last few years. So as liquidity goes the other direction, that's become a major headwind for these areas. And the part that the market's missing most, I think, is people have this impression that these are defensive areas of the market, that they're not cyclical. Obviously, that was the case in the pandemic. But if we go through a typical run-of-the-mill kind of economic slowdown, their earnings are going to slow down. You're already starting to see that show up in some of the results. And so it's probably not the time to jump in here.
Can you partition among tech, or do you throw them all out with the bathwater?
Yeah, obviously they have different characteristics and different, cash flow profiles and different valuations, right? So, but the thing that sort of aligns them all is that they were all huge beneficiaries of the ride up here. Over the last few years, there was massive flows coming into all these parts of the market, whether they were higher quality names or lower quality names, and that boosted sort of its rising tides for all these boats. So as those tides come down, I think that's going to sink all ships as well. I mean, you saw the same story back in 2000. Just go back and look at the Intel, Cisco's, Microsoft, Oracle's, Sun Microsystems of the time. Those were the names back then that everybody said were rock solid industry leaders that weren't going away. That didn't stop those stocks from going down 50, 60, 70, 80%, before finding a bottom and basically not making your money back for another 10 to 15 years. So I think that's the same story. Remember that 6 or 7 years ago, Apple traded at, less than 10 times, it got up to like 30 times. So, right, that rising tide didn't matter if you were a good company or bad company. It benefited all these companies.
So what do we need to price in, or what do we need to see to show that everything's priced in? You could argue that Apple goes the way of a Nokia, but surely you're not going to argue that Google ever has competition, or Amazon.
Yeah, I think, to answer the second part of your question, I think, the big difference now in terms of the growth outlook from here, from say 10 years ago or 20 years ago, is that they're all competing with each other across all these different verticals. 10 years ago, 20 years ago, they were all sort of growing in their own respective niches, right? Now they all have a streaming platform and an app store, and they're all, a web storage platform. So they're all competing on all these different verticals, and that's going to make that growth outlook from here, increasingly tough. In terms of like what the signs to look for, that we've reached the bottom, obviously I think the valuations have to come down even more. That gap between, those areas of the market and the rest of the market, I think needs to close. But it's not just a valuation story. What we're talking about here is a bubble. And the bubbles pervade society, and it still continues to. So I think the point that you'll know that we've kind of gotten through this, you've seen that capitulation, is where people aren't interested. The number of these tech investment vehicles, the number of tech dedicated segments on TV, the number of flows you're seeing into these assets, you'll see those decline. You'll see some of those heroes go to villains. You're not seeing any of that stuff stuff really yet. So I think it tells you that we're pretty far away from capitulation here.
Dan, there are people who agree with you, enough of them that they are flooding into cash as we saw the fund flows, as well as U.S. stocks, although perhaps not big tech until recently. And Bank of America's Michael Hartnett talked about these numbers and said that the U.S. is just a couple of data points away from a technical recession, saying that we're basically there. We just don't realize it. Do you agree, and do you see material downside on a broader level besides just tech for the broad indexes?
Yeah, Lisa, obviously, Mike's a friend of mine and always someone you should listen to. What's interesting is the note he just put out last night was actually the opposite story, where actually people were flooding, they were taking money out of cash, right? I think the cash story in and of itself is a dynamic that's sort of different this time around, because usually when you're seeing these huge inflows into cash, it's coming from stocks. People are afraid of stocks that are going into cash. The story this time around is they're afraid of stocks a little bit, but they're actually also afraid of bonds a lot. And so you're getting that story is kind of, it's not just a stock story, right. It's an overall asset class story. The part about the recession, I think, the risks of eventual recession are rising, but I think what's clear from all the data that we're getting over the last few weeks and last few months is that this economy is not falling off a cliff today, and actually is quite resilient. So I think that eventually those risks are rising, but for the here and now, I think people are getting maybe a little too pessimistic too early.
Dan Suzuki, thank you so much for the brief with Richard Bernstein and Richard Bernstein Advisors. Lisa, I've got DXY just out to new strength here as well. I think we've got to go back and revisit yen. Bloomberg News with a terrific update on the institutions in Japan monitoring yen 133.86. But I'm sorry, Lisa, it's simple. Into this report in some 50 minutes, Euro can't get a bid.
Yeah, Euro can't get a bid because, frankly, they can't get ahead of the concerns about the peripheral region blowing out and really losing steam. How are they going to coalesce around a higher rate without torpedoing that economy? Interesting to see. Also, you talk about Japan, this idea that Japanese officials are coming out and getting a little bit concerned, at least verbally, about how weak the yen is becoming. And this goes to the question that Matt was asking earlier, which is, when is a strong currency good or bad for a country? We used to think that weak currencies were good. Now it's not clear because it's importing inflation.
Lisa, we got to go through the yield complex. 2.86% 2-year, 10-year yield nicely above 3%, 3.04%. And I'm sorry, I got to look at the old benchmark, the 30-year, 3.15%.
That's the reason why I watch auctions. It was a really strong auction yesterday,
Hey, how
Tom.
was the 3-year auction? Remember because that was the first one the Fed wasn't participating in, $44 billion?
That was a little bit weaker, and this really speaks to the issue that we have been seeing, which is people expecting the Fed to do that much more. Longer term, that's going to take growth away. I really am curious to see in this inflation report how much people decelerate spending in certain areas. For example, airline tickets. I know, Tom, that's a habit of yours, is to look at different tickets,
we're
different
monitoring
places.
them, and they've actually come down a little bit.
Exactly.
I really wonder if it's demand destruction. I look at New York LAX, and it's ebbed off a little bit as my amateur take on that. We'll maybe get more data on that with this report and into the weekend as well. At 8:30, our Michael McKee will join us with some important view of the inflation report, and then we will speak to some esteemed economists. Stay with us. Red and green on the screen. This is Bloomberg on Bloomberg Radio and Bloomberg Television.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Ukraine must clinch a new loan program with the International Monetary Fund. That's according to the country's finance chief, as efforts to fight off invading Russian forces push its budget and international reserves to the limit. Finance Minister, Serhiy Marchenko tells Bloomberg that Kyiv needs more foreign aid from its long-standing donor and that early talks on a new aid package are underway. Hong Kong stocks are already rebounding at the fastest pace in the world, and a possible visit by Chinese President Xi Jinping in a few weeks could provide even more buying momentum. There are growing signs that Xi will join a July 1st ceremony to swear in new leader John Lee, as well as celebrate 25 years of Chinese rule. The Hang Seng China Enterprises Index has gained 16% since mid-May, outperforming every major benchmark in the world. More than 2 years after the coronavirus pandemic began, there are still questions about how exactly it started. World Health Organization Researchers say more information and research are needed to look into the possibility that an incident at a lab in Wuhan, China was the initial source of the outbreak. Advisors say there should also be further study of a market that's been identified as another possible source. Shares of Credit Suisse moved lower today, hovering near their lowest level in at least 30 years. That after State Street denied that it's interested in taking over the Swiss lender. Credit Suisse shares have lost half their value since the peak in March last year, hurt by major financial and reputational losses stemming from the troubles of its Greensill finance funds and the Archegos hedge fund implosion. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Cathie Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
expect to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. If the medium-term inflation outlook persists or deteriorates, a larger increment will be appropriate at our September meeting.
Christine Lagarde talking about the medium term in economics, folks. That is uniquely British and uniquely European. You will rarely, if almost never, hear the phrase medium term among American economics. We will go short, medium, and long term in 40 minutes with today's exceptionally important inflation report. Thank you for joining on radio and television. Tom Keene with Lisa Abramowitz, Matt Miller in for John Farrow as well. And right now, we digress. We go to the Port of Los Angeles, but that barely describes this morning our more than ancient president as he will stand on the USS Iowa and try to bring a summit of Americas to a better place. Ed Ludlow is in Long Beach and joins us this morning. Ed, I think it's absolutely remarkable to see the public service in the Atlantic and in the Pacific of the USS Iowa of decades and decades ago, and no, forget about it. It's a new America and a new Pacific. What does the president want out of the Summit of Americas to show across the Pacific?
Yeah, I mean, his focus has been on Western leadership. You look at some of the commentary he made in his remarks about the West potentially could be a leader in all things freedom, all things capitalism, all things progress, a kind of hint that perhaps right now the Western world's not pulling its weight. You talk about the Iowa, you know, what we expect from Biden here at the Port of Los Angeles is fighting talk that is specifically dialed into inflation. You know, he's been talking all week long about the way he can tackle inflation is solving what's happening behind me in terms of the log jams that we've experienced in the last 18 months or so. Because for him, outside of his role as an international leader, his biggest pressure point at home is that inflation we're seeing and how it's hurting Americans.
Is the inflation report in 40 minutes, has it overwhelmed the manufactured Summit of Americas?
Has it overwhelmed the what? Sorry, Tom, you broke up.
The Summit of Americas. Has it overwhelmed all the planning around today's festivities?
Yeah, I think so. I think for our global radio audience as well, the chart I keep looking at is Biden's approval ratings, a downward trajectory on that line, and inflation, the upward trajectory on the opposite line. You know, that we face a real global story still around what's happening in the movement of goods from A to B. I think what's fascinating right now in the context of inflation is that we still have signs that demand is there. We've learned that from the latest earnings season from corporate America and retail. The thing that's happening outside of America is that China is coming back online, and their factories are turning out consumer goods that frankly haven't been able to make their way here. So we're embracing mode here at the Port of Los Angeles for that volume to come through the port. And that's why he's so zeroed in on the impact of what that would mean for higher prices.
Is the port, I mean, Bloomberg Television has been covering the Port of Los Angeles very closely. Caroline and Romaine, I believe, were actually out there. You're there now. Is the port running at full capacity right now? Because we're worried about a strike, right?
Yeah, so the situation is that the port has set consecutive record quarters for volumes. That the Port of Los Angeles, along with the Port of Long Beach, its neighbor, handles the bulk of container movement in and out of the United States from an import-export perspective. But in June of 2021, they did 10 million units over a 12-month period for the first time. There's just a dramatic ramp-up of what's coming into the country. In the context of inflation, thankfully, container rates have come down. You know, the bottlenecks that we have been talking about for 12 months, the way they manifest themselves is the bottlenecks impact the available supply of containers. When there are fewer containers, shippers have to scramble to find alternatives and thus pay higher prices. We're down 27% from a 40-foot container price from its September peak. But this is the concern, Matt. If there is an impasse between the longshoremen and the warehouse union and the PMA, then that will again disrupt the ability of containers to move in and out of ports. That impacts supply, and it leaves those moving goods around the world facing higher prices once again.
What can the United States do unilaterally, or what can the Los Angeles port do unilaterally to increase this, and how much is this really just a global issue?
That's a fantastic question, Lisa, and they haven't answered it very well. You know, the port will tell you here, Port of Los Angeles, and we're going to speak to the CEO and Executive Director, Gene Soroka, later, that they're going through this modernization program where new technology, cranes, automation are making it more efficient. If you speak to the longshoremen themselves and the truck drivers, they'll tell you that that is not the case in real terms. What Biden has been doing is basically putting pressure through two men, Labor Secretary Walsh and Transport Secretary Buttigieg. And he said to them, you two go out, get the parties together in a room and get this sorted. We know that Biden's a pro-union president, but the reality is that the longshoremen themselves, who are well paid, by the way, in some cases here in LA, a longshoreman can earn $100,000 a year and have benefits alongside it. But they're feeling the pinch of inflation just like everyone else. And what has happened over the last 12 months to 2 years is difficult working conditions because of the pandemic, intense volumes passing through this port, 10 lanes of volume passing through only 5 available lanes. What you see behind me is the main channel of the port. It's one of only 5 that are available, but that's the way the port talks about it. There's 10 lanes of volume trying to fit into a space of 5. So it's about getting heads together, and you think Biden's message today will be about, come on guys, this is important, get your act together.
Ed Ludlow, thank you so much. Early in the morning, Long Beach, California as well. Lisa Allen Ruskin publishing moments ago with Deutsche Bank and making clear the importance of the ECB decision yesterday and the idea of what it means for a constructive U.S. dollar tone.
Even if they start to raise rates at an accelerating pace, they are dealing with the potential existential threat to the euro area, as well as slowing growth, which is a different picture than the United States. How much can the Fed go before those growth concerns really start to eat away at some of the dollar dominance?
Matt, explain to us where we have $6 a gallon gas here, which would be cheap in Germany. Is there a gallon of gas angst in Germany and continental Europe?
Well, I have to say that I moved back here in January, so right before the pump prices really went up. But I was paying, on average, over the 5 years that I lived in Berlin, $6 to $7 a gallon. I know it's gone up there, but they don't need to drive as much as we do, right? They have public transportation that links cities, towns, villages. So there are a lot more options in Germany than there are here in the gigantic United States of America for getting around.
Matt Miller, I got about 8 more questions on that. We'll try to get back to that here in the busyness of the next 35 minutes. Again, an inflation report, Michael McKee doing what he does best, and then we'll have some good conversation. We are thrilled to tell you that Michael Darda will join us here after Mr. McKee at 8:30. Michael Darda is focused, like you are, on the nominal economy and on top-line CPI. Michael Darda, always a part of the surveillance dialogue as well. Jim Paulson will attend as well, Chief Investment Officer, Luthold Whedon. Stay with us. Inflation report in 34 minutes.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And the key question is whether inflation will trigger a recession.
Most companies were able to pass on a lot of these costs. Indeed, that's exactly what inflation is.
Inflation is being driven by energy. The fact is these oil prices are going to be at $120 a barrel or higher.
What I think that you're ignoring is the adaptability of people and the economy.
I don't think the U.S. falls into a recession. I think China's probably going to be enormously stimulative in the second half of this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Countdown to the most important economic data point of the week. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, John Farrow, Lisa Abramowitz. Today, John out, Matt Miller very much in. Thank you for being with us. And Tom, this is a huge moment that we're leading up to in a half an hour, economically as well as politically.
Good conversation with Jim Paulson and Michael Darter coming up as well. Lisa, what I would note is it's markets on the move. We saw the adjustment yesterday of ECB. We see continued weaker euro, and moments ago, Brent crude reaffirmed $124 a barrel.
The move is up, at least in the short term, with inflation, and down when it comes to growth. How much does a strong read today, Tom, really bleed into this feeling that growth concerns are going to be very much on the front burner for the remainder of the year?
I think we're going to get there. I mean, I thought that Alan Ruskin publishing in the last 20 minutes at Deutsche Bank really showed the ambiguity that we're going to see of a bipart report. Lisa, we've got top line emotional 8% like inflation, maybe 9%, who knows? And then we've got this core number where a number of people, including Hatzius at Goldman Sachs, says, you know what? Maybe we get the first signs of ebbing core inflation. That complexity feeds into the mystery of American growth.
And the pessimism that we're seeing bleed through some of the equity markets, Matt, raises the issue of margin compression, how much what we saw from Target, what we saw from other retailers are outlier issues having to do with the composition of sales versus an endemic issue for corporates more broadly.
Yeah, absolutely. I mean, the concern you're seeing in the market and the move down I think really comes down to inflation eating away at profits. And as you put it, margin compression. It sounds so much smarter, but it's the same thing, right? I'm not sure how much the ECB feeds into the 2% drop on the S&P yesterday. I didn't really get any surprises from the ECB. They seem to be slow to act and sort of pushing the ball forward in a way that they have been all along. It'll be interesting to see how the Fed and how President Biden especially reacts to the inflation numbers that we get today.
And again, as growth concerns start to really dominate the conversation, Tom, I'm looking at the S&P cooling off a little bit, even as we see people going back into big tech. And I find this fascinating. This was a haven until it wasn't anymore when rate concerns were on the table. Now we are looking at growth concerns. And all of a sudden, around the margins, some people are warming to the idea that a cash flow behemoth like Apple, like Amazon even, although to a lesser degree, and like Microsoft, will continue to generate some cash.
Oh, that's good. It's going to be interesting to see on the big tech companies. We heard Dan Suzuki of Richard Bernstein make real clear that tech is a sort of amorphous and is out there and maybe won't perform. But I would remind everyone what an ugly close we had yesterday. Lisa, why don't you start the data check? I'm going to point out Euro 106 down to a weaker 105.75.
Yeah, and leading into that after yesterday's downturn, we aren't seeing that much action, basically flat on S&P futures at 4,014. The euro, though, and I do think this is interesting given the fact that the ECB signaled their rate-hiking cycle, that it would be a cycle, that they were open to 50 basis points of a rate hike. That was not enough. And just ongoing euro weakness, 105.74 right now versus the dollar. Also interesting is that 10-year yields were lower on the day earlier in the session. They have turned higher, 3.04%. We have crossed that 3% threshold, Tom, and we are continuing to see that. How much further can it go, especially with all of these growth concerns, Tom? I mean, that to me is one of the big issues.
And what's important here, folks, in 26 minutes is this is not thumb up, thumb down on the CPI report. There's going to be real nuance from McKee into Michael Darda.
Yeah, and parsing out the data into a market reaction is not a clear line. Parsing out the data into a reaction, as he called it, the firing squad that we're going to be hitting in less than a half an hour. Jim Paulson, Chief Investment Officer at Leuthold Whedon Capital Management. You said that in the break. I'm going to throw you under the bus by revealing it to all, that we feel like we're about to hit something massive. What is the balance
Facing
of risk?
a firing squad.
Yeah, what's the balance of risks right now heading into this report, that it's hotter than expected or cooler than expected?
Well, I think it's important to realize that we got a lot of emotion here in this market. I mean, leading up to this yesterday, and that's probably the biggest story of the day. It's less about the fundamental data than it is about the emotion that's around this. And that's why I said that. It does feel like we're walking the plank or we're at facing the firing squad here, all on one number. And these numbers, economic reports, can be hugely volatile and revisable and all kinds of things. And we're going to put a lot of weight on this in terms of what happens for this close on Friday. But, I still think, to me, when I look, oil is still going up. Oil and gas at the pump is still going up, and that could feed in, so particularly to the top line CPI numbers here. But most all the rest of the numbers, commodities as well, including food, agriculture commodities, are flat to down. Industrial commodities are down. Used truck and car prices are down. Freight rates are down.
That doesn't change the fact,
I see a lot of evidence of a peak.
The thing is, as Lisa points out, a lot of lower wage earners are having to choose between, food and gas, and even rich people, right? We've seen surveys that say if you make $250,000 a year or more, you're still, 36% of you are living paycheck to paycheck or something like that. I mean, this is really difficult for corporate profits, for people who rely on consumers spending disposable income.
There's no doubt about that, Matt. It's tough. I notice it too at the pump here. We got almost, getting it close to $5 a gallon, and you definitely notice it when you fill up, and it affects you. There's no doubt. We are slowing the economy. That we are growing 12.2% real GDP a year ago, June. We're probably down under 3, maybe 2.5%. right now on a year-on-year basis. That's considerably slower growth. And that's a good thing. And I think what we got is a mid-cycle slowdown, but I don't think we have a recession going on. And if we don't have a recession, then I think the fundamentals will hang in there. And thankfully, we got some of the best balance sheet strengths, most liquid and strong balance sheets we've had maybe in decades, and I think that's going to be a good defense.
Jim, there can be all sorts of mysteries out there in this inflation report in 23 minutes, and it would be no greater than the mystery that Mr. Cole of the New York Yankees could give up 5 home runs and still the Yankees would beat the Minnesota Twins, which sounds impossible. Let's say we get the same impossibility, which is a constructive core CPI number, a good tone, a lower statistic. What will the stock market do?
You know, Tom, I think you may raise a good point. I think investors are going to be more focused on that core number and evidence of the underlying core, because core tends to lead the top line numbers, and they tend to be more volatile in the underlying core. I think when you put that together with what wage inflation's been doing, growing 4% or less in the last several months, I think if we get a good core number, we could calm this thing down a little bit today. If the core number's hot, I think it's Katie bar the door is going to be a rout. But I think that's the key number. I agree with you.
Jim, 3 homers, boom, 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 5 homers total, and the dreaded Twins couldn't take out the even more dreaded Yankees? What does this say?
We took one from them. I was hoping we'd get 2, Tom. If we get a bear market in the stock market on Friday after a bear market for my Twins the last 3 days, it just isn't fair out here.
It's not fair. I'm going to be more optimistic than that. Jim Paulson, thank you so much, with Leuthold Whedon, I should say, today as well. Lisa, I look at the moment we're in here, 21 minutes from this inflation report, and I've got to admit, I've never seen a focus on it as we have now. And you have to ask why. And to your point, Lisa, it is this ancient fear of demand destruction, whether it's direct in a household or indirect within a greater economy.
The why is really simple. Everyone is feeling this, right? This is unheard of over the past 40 years. We have not seen inflation like this, and it's not coming down very quickly, if it's coming down at all. And people are talking about peak inflation. Are we even seeing that right now, or do we have more to go? I mean, that was what Mohamed El-Erian was pointing to yesterday on the Open at Bloomberg Television. Honestly, this is the issue for people. They are feeling it. So it is emotional, as Jim was saying, Tom.
And of course, we could reach back into the ether of the past and notice in Matt Miller's driveway, I could see it coming, Matt, with 9% inflation in the gloom of the moment, $7 a gallon gas. Matt Miller driving a VW diesel, I just think, it's a feasible outcome.
I'm happy to drive any diesel. It's actually my preferred powertrain, but I prefer Ford's 6.7 liter Power Stroke with over 1,000 pound-feet of torque.
Font of wisdom. Why is diesel more expensive than gasoline?
Because there's no choice. The people who drive diesels, not like me for fun, but for work, have to drive diesels. So the gas station can charge whatever they want, and truckers must pay that.
I don't know. I mean, Lisa, should we let him on the show? He knows so much about
I like that distinction.
These automobiles.
I like the distinction between diesel and gas. Why is it the cash and credit card?
Well, no, but seriously, in the old days, diesel was cheaper. Now diesel is more expensive. One of the changes from the 1970s. Please stay with us. In the next 15 minutes, a key inflation report. On Bloomberg Radio, on Bloomberg Television, good morning.
Keeping you up to date with news from around the world. With the first word, I'm Ritika Gupta. The Biden administration is trying to avert another inflation-spawning logjam at the nation's busiest seaport. President Biden will visit the port of Los Angeles today. The White House is closely watching talks on a new union contract for 22,000 West Coast dock workers. A collapse of the negotiations risks a work stoppage that would snarl U.S. supply chains still suffering pandemic disruptions. U.S. Defense Secretary Lloyd Austin met his Chinese counterpart on the sidelines of a major Asian security forum in Singapore today, where both countries are pressing their competing visions for regional stability. The U.S. is hoping to use the forum to establish guardrails to prevent competition from getting out of hand. The meeting comes as the war in Ukraine consumes Washington's attention and Beijing struggles with economic pressures at home. Shanghai will briefly lock down nearly all of the city's 25 million residents this weekend for mass testing as COVID-19 cases continue to emerge. The flare-up is causing more disruption and triggering a renewed run on groceries just days after the city exited a 2-month shutdown. Health officials are testing to root out any silent transmission of the virus, a key tool in China's COVID-0 arsenal. And Amazon doesn't want to get into a bidding war for the rights to stream Indian Premier League cricket matches. Bloomberg has learned the company plans to withdraw from a heated competition for one of the world's most popular sporting contests. The surprise move leaves the field open to Ambani's Reliance, Disney, and Sony. The rights had been estimated to fetch an unprecedented $7.7 billion. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
I think Europe's falling into a recession. It's got a tightening central bank now for the first time in a very long time. But I don't think the U.S. falls into a recession. I think China's probably going to be enormously stimulative in the second half of this year.
Patrick Armstrong, really quite strong yesterday, the Chief Investment Officer, Plurimi Wealth there, on the framework forward, which is now confusing after ECB yesterday, and in 11 minutes, we'll get a CPI report. Michael Dart is scheduled to join us right after Mr. McKee digests, as he does best in the world. Right now, on the interest rate space, as they call it, Ira Jersey joins as Chief U.S. Interest Rate Strategist of Bloomberg Intelligence. Ira, which matters? The short end yield up because of Fed worry, or the long end yield lower because of Fed worry? Which matters more?
Well, I think for the overall economy, it is that long end of the curve. So when you wind up having interest rates, hovering 3%, if short-term interest rates continue to rise and maybe even rise faster, and one of our calls has been that we think that the Federal Reserve is going to go a little more than the market is currently pricing. But when you think about where corporations fund themselves, when you think about things like mortgage interest rates, even though mortgage rates have been rising quite significantly, they're not likely to go up a lot more if long-term rates hover 3% plus or minus a couple of basis points. So I think it is that long end that for the economy overall really matters a lot more.
Is it significant to you, Ira, that even after the strong auction that we saw yesterday, that we're starting to see 10-year yields tick higher despite the growth concerns, despite the fact that people are expecting the Fed to be somewhat aggressive?
Yeah, I do think that the entire curve is going to bear flat, and if the Federal Reserve goes, say, to 4% instead of 3.5%, like the market's currently pricing, so I do think that 10-year yields can retest the high. The question is, if they get back to 320, 325, our target's 325. If we get much higher than, how much higher than that can we get? And I don't think much. And in an environment where you have real growth slowing, you do have demand destruction. We are talking a lot when we look at this data. When you have services prices going up but goods prices potentially going down, you wind up in an environment where long-term interest rates will have a cap. Now, is that cap 3.25, like I said, or is it 3.5? That's something obviously a matter of debate right now. But we do think that we've seen most of the move in longer-term interest rates already. And remember, this is a massive move. This is going to be the worst year for Treasury returns ever. The question is, how much worse will it get at this point?
Do you think that the balance of risks, and I was asking this earlier, but the way that the market is set up currently, do you think people are positioned more for an upside surprise, a bad upside surprise given where we are with inflation, or a downside surprise where you're seeing it cool off a little bit more than expected?
Yeah, I think people were squaring positions earlier this week, and that's one of the reasons why you had people maybe in kind of bull steepeners getting out of those kind of trades and then wind up turning into a bull flattener a little bit earlier in the week. It feels to me like the market is reasonably flat, but I think the preponderance of risk is for there to be a somewhat higher print. In fact, we had a couple of trades in inflation swaps this morning that are suggesting we could see an 8.7% number for June. So the June numbers that that we get a month from now could show 8.7% year-on-year CPI, and that would be, obviously another record. So, and Bloomberg Economics has been pretty well in front of this, suggesting that maybe we haven't quite seen the peak in inflation. In an environment like that, you'd have to think that if nothing else, you'll wind up seeing additional curve flattening like we have today. And our call is for the 2-year, 10-year yield curve to invert before the end of the year. So, we're on our way there. We're only 18 basis points away, and I think that that's a very realistic possibility.
I was going to say it could invert before the end of the day. What is the consensus on trading desks? I mean, you talk to bond traders, treasury traders all the time. Do they expect a recession? Are they pricing that in?
Yeah. Well, that is one of the reasons why you get this inverted yield curve, Matt. Because what happens is that we price for reasonable growth for the next year, and then after that you have start pricing in the Federal Reserve to cut interest rates and for recession to kind of take hold. The challenge I think for traders right now, particularly for nominal everyday treasuries, is how quickly does inflation decline, right? So inflation will decline somewhat naturally, but as it declines, will we see 5% inflation at the end of the year and then 3% inflation at the end of 2023? And in an environment like that, it's hard to be very long treasuries here. So if you get long treasuries, it's either because you have to or because of your mandate, or you're getting long because it's just a trade. It's just, hey, we've gotten a little cheap compared to other markets, and we have to get long. The other thing, and the other reason, just to go back to Lisa's point, one of the reasons why we see people buying treasuries on days like yesterday is just because it's just an asset allocation trade, right? Risk is off. You have the stock market down 2%. People migrate naturally to the risk-free asset and wind up buying 5 and 10-year treasuries to kind of rebalance their portfolio for a risk-off event. But I don't think that'll persist in any significant fashion, just given the inflationary environment right now.
Ira Jersey, thank you so much. Greatly appreciate it. Lisa, as we go into this report, 6 minutes away, and I want to bring up the screen. On Bloomberg Radio, it's a beautiful graphic of the lumpiness of inflation. And Lisa, I think this has been underreported. Ben Emmons was out today with a very nice observation on the stickiness of inflation. But the idea, there it is, energy up 11% month over month, energy commodities, distillates up 18%, food up maybe not all that much. But this is not homogeneous, Lisa. You really have to tear it apart.
Which is the distinction that people are making between goods and services. Do we see a disinflation of goods and then a move to services? How much can we see that if we continue to see the input costs, energy being chief among them, being so high? And then what do you do in terms of a deceleration on the services side? Is that a good thing, considering, again, that the consumer makes up 70% of the U.S. economy? Do you want to see a deceleration in the areas that are supposed to be recovering now?
And Matt, you've got the 7,000 square feet up, out in the burbs of New York. And I mean, you're keeping it at like, in Fahrenheit, folks, he's got the AC going like down to 62 degrees. And I mean, you're talking a mother of all utility bills, Mr. Miller.
Yeah, and I just bought a house at the very top of the market, right? And the S&P Case-Shiller Housing Price Index used to move up 5, 10, 20%. We've seen a 120% jump in that index. For the first time in history, a move like that. So I'm hurting, Tom, personally hurting.
But do you see housing breaking? Because that's part of this report here in 5 minutes.
To me, it's one of the most important questions. What happens to the U.S. housing market as mortgage rates jump, right? We're up at 5.58 if you look at the bank rate, average 30-year.
And that's still linked into that 30-year bond, 3.15%. Michael McKee will consider OER, owner's equivalent rent, in this very important inflation report. Stay with us. Michael Darda next.
end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Moments away from the biggest data point of the week, U.S. CPI, consumer inflation for the month of May. We are going to get those numbers. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, Jonathan Farrell, Lisa Abramowitz, John out, Matt Miller very much in. Also in are the numbers. Michael McKee, our economics correspondent, with that data. Mike.
Well, Lisa, this is not going to be news. Good news down at 1600 Pennsylvania Avenue. The CPI comes in up 1% for the month of May. That is higher than the 0.3 we saw in April and much higher than the 0.7 that had been forecast. Core comes in up 0.6%. That is the same as it was the prior month, but it is higher than what had been anticipated. On a year-over-year basis, when you're looking at where inflation is, we thought we could say it peaked last month. It did not. It was up 8.3% in April, 8.6% for the month of May. That matches the all-time high in this cycle. And the core rate up 6%. That's a little bit lower than last month's 6.2%. And that's kind of what we've been expecting, given the fact that the energy complex is driving so much of what's going on. And let's take a quick look at that. Gasoline up 4.1% in the month of May. And that was one of the things that had dropped in April on a year-over-year basis. Gasoline 48.7% higher than in May of 2021. Taking a look at food up 1.2%, and that keeps the year-over-year rate at 10.1%. Used cars and trucks, everybody's bogeyman since the pandemic began, were up on the month by 0.7, so they are up by 5% year over year, a little bit lower than it has been. But overall, we're seeing very, very strong gains, and Lisa, the number for shelter up 0.6%, 5.5% on the year. So all of the categories that have been pushing us higher are still doing so.
We're seeing some big moves in the markets, particularly on the front end of the yield curve, surging at one point very much clearly to the highest level, and even on an intraday basis going back to November 2018, close to 2.9%. We are seeing that sell-off accelerate on the equity market. This is all the kinds of downside surprise that you're going to want to see. It is now a new peak inflation. We had expected to see the peak inflation last month. It was not. In the month before, we saw an acceleration. That sell-off increasing. And Tom, right now, that NASDAQ getting absolutely slammed before we saw some gains, now down 1.4%, exceeding the declines that we saw in the S&P.
I just really want to state that this is an extraordinary report. This completely refutes any idea of ebbing inflation. It will take time to go into the markets. Dow down 300 points, well under 32,000. S&P not on its way to 2,900 and what we heard the other day, but under 4,000, down 43 points. Critically, the VIX, 27.31, and you really wonder after yesterday's afternoon, folks, do we revisit a 30 VIX today? Michael McKee, you were massaging this data, but what I see here, Mike, that is so important is the linkage of core up with headline up. How big a surprise is that, Michael McKee?
Well, going into it, Tom, a lot of people had looked at the energy complex in particular and said we were going to get an upside surprise, and that was the lean on Wall Street. So the fact that we're seeing a big sell-off in futures is something of a surprise because people were kind of expecting this. The question is, how much can you divorce food and energy from the overall inflation picture? On an economic basis, we are expecting core to level off. We did see a big rise in the airfares of 18.6%, or the month before, 12.6% this month. So that's still a problem area, but most people are going to focus on gasoline and food, and certainly down at the White House, that's what they're going to focus on.
Is it unfair, Mike, to ask if you had an ability to focus on the real estate components of inflation?
Yeah, I was just looking at owner's equivalent rent, and it was up during the month by 0.6%, and that is the highest in about 3 or 4 months. So we are seeing rent still work its way into the CPI, and it's a very big component, about a third of the CPI. It doesn't show up as much in the PCE, which the Fed follows, but you can bet that Fed officials who have to come up with a new forecast for next week are busy revising up at this point.
Everyone was talking about inventories, the buildups that we saw at Target and Walmart. Not that I necessarily need a T-shirt to live as much as I do a house, gas, and food, but are you seeing that come through in this report?
We are not seeing the same kind of changes, Matt, and because of the main fact that this report tends to emphasize some areas that the Fed does not. But we are seeing a little bit of discounting. I don't have the number right in front of me for the for apparel, but I can find that for you pretty quickly. But the big issue, of course, is what is it going to do for when you fill up a tank, and Tom, you know this, when you fill up a tank and it costs you 80 or 90 bucks, you're not going to go buy that T-shirt that Matt Miller wants.
Michael McKee, thank you so much. Greatly, greatly appreciate it. Folks, to sum this out very much, this is a report that pushes against any optimism on core CPI. Core number goes from 6.2%, yes, down a little bit, 6%, but not the 5.9% surveyed. And headline flat out goes the other way. This is a report that shows the angst that President Biden will speak of in Long Beach. Our Ed Ludlow with the president in California. Quickly on the data, Dow futures a negative 300, SPX a solid negative 50. Real deterioration with a VIX out 1.21 points. 2-10 spread flattens in further. 18 beeps down to 16 beeps, and the 10-year yield 3.05%, maybe a little more quiescent than what we see in equities. A good time to speak with Michael Darda of MKM Holdings. Michael, I want to work at the nominal basis because that's where our listeners and our viewers are at. Forget about Fed talk. Forget about real inflation. How do we withstand a nominal inflation rate of 8.6%?
Well, Tom, I think this is exactly what you end up getting when you run the nominal economy hot at double-digit growth rates on average since the bottom of the business cycle in 2020. Any look at historical experience will tell you that. And unfortunately for households, if we look at the May data, the proxy for nominal income out of the jobs report, which is essentially just wage growth, hours growth, and employment growth summed together, annualized it at about 10%, all of that being eaten up by inflation with today's report.
That's where I wanted to go, Mike, and that's what I was watching was real average hourly earnings, both on an hourly as well as a weekly basis. On a weekly basis, it is now the most negative that it's been in data going back to 2006, negative 3.9% in terms of how far behind wage inflation is falling behind the actual stuff we buy every day. What does this do to your growth outlook, Mike?
Yeah, I think unfortunately, we're dealing with a little bit of a stagflationary environment here, at least for the month of May. So obviously we've had some intensifying shocks in food and energy prices. So hopefully at some point that will reverse. But, as Mike McKee went into, this is an inflationary process that has been broadening and deepening out. So you've got pressure on rental inflation. That's a significant portion of the CPI. If we look at services inflation, excluding energy, that's 60% of the CPI, it's running at more than double the average of the last business cycle. So it might be a bit of a fool's errand here to just assume that if crude oil prices back off, all of a sudden a magic wand is waved and the inflation problem simply goes away.
Mike, we thought that we had seen peak inflation. We had not. We now have an even higher print that is a new post-1981 high. Is 8.6% the high water mark, or are we going to see even higher ahead?
Well, I think we're probably pretty close to peak inflation on a year-over-year basis, but none of that may matter for the path of Fed tightening and the bond market and equity market valuations, because if inflation eases from here but still stays very high, then that is not an environment where the Fed just moves to the sidelines and we see some kind of huge revaluation and expensive equities that dominate the market cap of the S&P 500. So there are some macro commentators making kind of bizarre arguments, at least from my perspective, that aren't focused sufficiently on the nominal GDP backdrop, which is still way too strong. Aggregate demand is still way too strong, so the Fed has more work to do. And the fact that if inflation eases but is settling in at rates that are several times the Fed's target acceptable inflation over time, then that's still going to be a problem for the bond market and a problem for the Federal Reserve.
Well, and, Mohamed El-Erian, who was on yesterday with John Farrow, said, if you think we're going to have a recession, sure, inflation's going to come down, and I'm paraphrasing here, but that's not what you want to see, right? That's not how transitory inflation should be affected. So is that the way we're going to see it?
Well, Matt, I think unfortunately, eventually that's where we probably end up. But the critical discussion is timing there. So I don't think that we're in a recession now, and I don't see a recession this year. I think the recession will come after the Fed gets itself into a restrictive monetary posture. And that's going to take some time. Consider this fact. Forget the backward-looking numbers that we just got, as shocking as they are. The Fed funds rate relative to 5-year expected inflation is still below 200 basis points, minus 200 basis points. And that is below the trough of the last business cycle when you had very slow growth and, and very weak realized inflation. And so this Fed is still behind the curve, and that is going to create a situation where these underlying drivers of inflation, like services and rents and wages, are likely to continue accelerating.
Well, Michael Dart, that's right where I wanted to go, because frankly, folks, the most important inflation data of the day after this shock is at 10 a.m. with a five-year forward Michigan statistic. Michael Dart, what are the ramifications to the economic zeitgeist if we get the 5-year Michigan look to break out above 3%, to break out of the inflation level of 2006?
Yeah, I think the FOMC would take note of that. Those measures are a bit stickier than the bond market break-even measures, but they are elevated marginally relative to their averages of the last cycle. And if we start to see any kind of what looks like a breakout, I think that would create a lot of consternation on the FOMC that these high headline inflation numbers are bleeding into longer term expectations. And, I think the Fed would be alarmed by that.
Michael Darda, thank you so much for the insight. Michael Darda, MKM Partners. I can't say enough about his linkage of the equity markets into what we see in economics. Futures are negative 34. Dow futures were negative 300, down negative 200. But the VIX 26.92. 10-year yield and even 3% has come in. It's got a little bit of growthiness feel to it right now. But Lisa Abramowitz quickly here, flattening of the yield curve while Darda was speaking, he was single-handedly driving the curve flat.
Well, perhaps that isn't the entire reason, but we are looking at this expectation now fully baked into the market that the Federal Reserve is going to raise rates 50 basis points next month, the month after, and the month after that. Basically 3 consecutive meetings. Well, how much do they have to do that in response to issues that people are facing right now that are not positive for their cost of living? This is not runaway inflation in a good way. This is inflation that is crimping into the buying power of the average consumer, and that is the issue they're going to be facing.
And now for the primer to get Global Wall Street through this Friday morning, Michael McKee in Boston. Michael, explain why people like you look at the Ann Arbor statistics at 10 a.m. and why the 5-year view out 5 years is so important.
Well, for the Fed, it's inflation expectations because they believe that expectations drive actions. In other words, if you think prices are going to keep rising, then you're going to react to that by asking for more money from your employer or by spending more money now to avoid inflation later. And so they want to make sure that longer-term inflation expectations stay stable. And the Michigan series, being one of the older ones, is one that they watch. Now, the thing you have to remember about the Michigan series is consumers are lousy judges of inflation. They add several percentage points to what they actually are experiencing. So it will be interesting to see how this happens. You usually discount the Michigan number a little bit, but we have seen a fairly stable one. And so if people are starting to think this is going to continue to happen, that will be a worry for the Fed, and it would be something that would drive their public relations, if not even pushing them to do more in terms of raising rates.
Mike, if consumers are worried that inflation is going to continue, does that bring demand forward? In other words, do I buy something now because I'm worried that the price is going to be higher in 6 months?
Well, it kind of gets back to your earlier question about the T-shirt man, and I looked and they were apparel was up this month by 0.7%, which is a surprise given the inventories. If you are buying gasoline and food, those things you have to buy. So you're going to buy those on a regular basis. If you spend all your money on gasoline, you may not pull forward other purchases because you feel like you don't have anything left. But if you're worried that it's going to continually go up and you need something, that's when you'll go shopping earlier than you might otherwise have.
Michael McKee, thank you so much from Boston. He's, I'm sure, up there recovering from the Los Angeles Angels finally winning a game. Again, if you're just joining us, truly shocking inflation, which confirms the fears across America. This was scheduled before the inflation report and the importance of it. David Harrow, of course, always looking at price change across America. But far more, we've tried to get David Harrow on of Harris Associates to speak of EU banking. It has been an absolute shock. And David, I've got to start with Credit Suisse and the view back, I'm going to say 15 years or so before the great financial crisis of 2006. And it has been an abject value trap and an abject failure. You've been directly involved in this. You have been patient. David Harrow, have you run out of patience with the gnomes of failure in Zurich?
Well, not at this stage yet, because there has been wholesale changes at the bank from the board to the management down. And I think we need to see what the new people who are involved with the bank, both from the executive management committee and the board of directors, can do to turn this around. There is inherent value within the business. And I think these people should be given a chance to try to create this value and sustain this value. The bank trades at about 1/3 or 40% of book value.
Right.
So the object now should be stabilization and then growth after stabilization. And if they can't do it, someone else has to.
Do they have a Swiss put? Are they not making tough decisions because they know this government has their back, that Zurich will be UBS and that Zurich will be Credit Suisse?
I would hope not, by the way. I'm a believer in free market capitalism, and there shouldn't be any protection. If they can't do it and someone comes in to make an acquisition to all or parts of the business, I think that should be allowed to happen. Now, there's talk that if someone does bid, they will give UBS a chance to do some kind of a deal combination, but I would certainly hope that is not the case.
Is Europe even ready for big cross-border bank M&A?
I don't think you can have cross-border bank M&A in Europe on a wide scale until some of the rules and laws are changed. At some point, this may happen, but you still have fragmented banking markets, which it makes it non-conducive to cross-border. I think there is a possibility for some on isolated levels and basis, but at this stage, you still need regulatory evening out that would make it more conducive to cross-border M&A. On the other hand, a company like Credit Suisse has a huge private wealth management business, which is now bigger than their global markets investment banking business. And for any big global bank that wants exposure in this lucrative area, you would think Credit Suisse would be an attractive asset.
I got to ask you about China, because every morning it seems like futures lately are driven by the idea that China may get a little bit lighter on tech companies. Yesterday there was a report that Ant could revive its IPO, although that's been kind of poo-pooed. I see that you own a stake in Prosus, which in turn owns a stake in Tencent, right? What's your view on China tech?
Yeah, it does appear that we've hit peak regulatory initiatives in China. As you know, over the last year or so, they've been increasing regulatory scrutiny on the Chinese tech sector. So the whole sector's been kind of hit. We also own some Alibaba as well, and both these sectors have been hit. But we believe that even with this additional regulatory scrutiny, now keep in mind what's happened is these businesses around the globe have grown much faster than the regulators' ability around the globe to regulate them. And China's kind of taken a first stab. But what we have seen, what appears to be statements from the government that we're getting to the end of the regulatory initiatives. And then you even saw in the case of Tencent, lots of games that were approved this week. This is one of the things that they were concerned about, withholding game approvals, for the various reasons. So we are starting to see regulatory relief, or at least movements by the government that the worst is behind the sector. Right. And meanwhile, these are really well-run, world-class tech companies that trade at low double-digit multiples.
David Harrow, thank you so much. Too brief a visit, but we've got so much going on in inflation. David Harrow of Harris Associates there. We wanted to get that in on the absolute debacle that we see at Credit Suisse. Of course, we may have news on that over the weekend. Please stay with us for our reporting off of Zurich and London desks as well. Futures at -52. Dow futures were -300, -200. They now give way, which is no surprise, -356 with the VIX 27.24. I want to emphasize massive curve flattening, moving from 18 basis points in. We're now down 10 basis points, 0.10%. For those of you not attuned, these are small moves, but very germane to watching the Fed game. And we do have attendant dollar strength, assuming that the Fed will move faster. That off of a headline number of 8.6% on American inflation. Jonathan Golub is having a difficult Friday. He's at Credit Suisse, and of course, their chief U.S. equity strategist. John, I've got to get out in front of your research note. Will you amend your targets this weekend for Monday trading?
No, we won't amend our target. And I think, our call all along is that the inflation is going to be stickier at a much higher level. and we've been recommending companies that benefit from higher inflation. So there's two ways of thinking about this. Today's report is bad for the market in general, but there are certain companies that hold up better or worse in a higher inflation environment than others, and that's where we're focusing.
John Golub, what's so important to me here is the behavior, and I don't mean to harken back to the fossildom that I am in the 1970s, but let's look at the deck of cards. We've got the worst bond market since time began, price down, yield up. We've got these inflation numbers today, the Fed parlor game that we're going to see out to the end of the year. What do you and the Credit Suisse Securities Research Team feel corporations will do? In my estimation, they have to rapidly act even into June and July and make the plans that they thought they would make come October. Am I right on that?
You know, Tom, I don't think you are right on that. I think that companies in a very high nominal GDP environment, which is what we have, the underlying economy, for all the recession concerns, is fine. Revenues are rip-roaring strong, and so bigger companies in this environment have tended to do a bit of a better job of being able to maintain costs. But profits are really high. The thing which is getting smacked around, Tom, are the stock multiples, not the earnings. And that's important to think about.
So what kind of multiple do you think is right for this market, especially if the Fed has a terminal rate of 3.5%?
Well, first of all, I think that the Fed is going to, and I think this is going to lead the dialogue, that this conversation that we were having over the last couple of weeks, can the Fed pause in September? Well, we know that the answer to that now is no. And the Fed probably has to move beyond 3.5%. But we still have we have a very powerful earnings environment. The revisions, the kind of the analyst adjustment to the earnings, with all the discussion that we've been having about weak earnings, they're going up almost every day. So we think that the market.
So how much should investors be paying for forward earnings?
If you look at a corporate bond yield, which is what your discount rate, it's not Fed funds. It's still something like 5%, which is a low number. So we think that stocks are attractively valued at these levels, and we would be going in. The level of concern in the market we think is much higher than the underlying backdrop.
CIBC reported, and this is Catherine Judge reporting from CIBC Toronto, and folks, I think this really sums it up. CIBC calls this inflation report red hot, and they go, Matt Miller, right to the heart of the matter, which McKee alluded to, which is shelter is the most gain since 2004. We've been highlighting this today, folks, from Senator Manchin's Charleston, West Virginia, to Senator Miller's suburb north of New York. I mean, Matt Miller, this is nothing that anybody already knows. We are aware of this.
I mean, if you look at the, what's it called, the S&P, CoreLogic, Case-Shiller, we should really ask Bob to shorten that. If you look at their 20-city index and max it out, we're at a level that towers over what we saw in 2004, 2005. So in terms of the absolute level, it's just unbelievable the amount of appreciation you've seen in house prices.
John Golub with Credit Suisse with us here. John, you talk about the animal spirit of nominal GDP, but at 8.6% headline, is there a point where the inflation price change part of nominal absolutely overwhelms actual economic growth?
That's like the ultimate question. Like I said before, the earnings are fine. The stock multiple is in 5 multiple points is a decline in stock multiples this year. Today's news taken by itself should push the multiple down. The market, the futures are down something like 1.25% on this news. That is that's exactly what you'd expect to happen. But the market has already, adjusted, enormously for this inflation environment. So I think that the market probably has taken all the bad news into account already, which is one of the reasons why I'm not as concerned, not because this isn't a good report, but because the market's already discounted a ton of bad news. And most importantly, a red hot, and you're just talking about the CIBC report, a red hot economy does not equal recession. And this is a red-hot economy, not a recessionary economy.
John Golub, thank you so much. Greatly appreciate that. And we heard that from Michael Darda as well. Nominal, the top line. I sound like Matt Miller. I sound like Larry Kudlow from like 30 years ago at Bear Stearns, where nominal analysis matters as the Fed tries to tackle this. Matt, the greatest observation I've seen this morning with all the research before and after this red-hot report, as Catherine Judge calls it, is the basic idea from Ben Emmons that the scale of move that will be needed by Powell is like Volcker in 1980, and that with this inflation report, we've got to think about a new scale, and pushing against that is Golub's optimism about animal spirits.
Well, he is, Jonathan Golub has been a very optimistic person throughout, as long as I've known him. I will say that one of the most interesting things I learned today is talking to Ed Ludlow. Those longshoremen, they're going to strike for higher wages. And yesterday, Mohammed was saying, if you think that we're in a red-hot economy, now I'm paraphrasing here, watch out for those wage increases, right? And if they get that, it's going to keep driving up the inflation spiral.
And to end this hour, I really want to go through a complete data check. Matt Miller, help me out here. Equities deteriorate. Dow futures negative 410. I love doing the Dow futures, Matt, just to bust
when John's not here.
chops. S&P 500 negative 60 there, and the NASDAQ. Let me get the percentage move there because Pharaoh's had to be medicated over the Dow quote. NASDAQ percentage minus 1.8%, and now the VIX out at a 28 level, Matt Miller.
And don't forget, this is after a 2% drop yesterday, right? I mean, we already had, markets were anticipating this. I don't believe that the sell-off yesterday was off of Christine Lagarde and the ECB here in the United States of America.
It was in front of this report.
They were all watching this report.
Okay, let me parse through the data here as we end this hour. Please stay with Bloomberg through the day as you can on radio and television. The yield curve screams further Fed action. The 2-year yield is up 11 basis points, 0.11%, and the 30-year bond yield is down 4 basis points. So that's a call it 15 basis point swing between the 2-year and the 30-year off this historic report. The nation considers 8.6% inflation. The president will speak at 1:45. This is Bloomberg.
Markets plunging after a surprisingly hot inflation read from New York City for our viewers worldwide. I'm Lisa Abramowitz in for Jonathan Ferro. The countdown to that open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue, more fuel for the Fed.
The CPI report, the U.S. CPI index.
The key is going to be not so much the headline.
We need to know, have we reached this peak inflation scenario yet or not?
The risk here really is that inflation becomes unhinged even further than what we've already seen.
In the face of 5, 6, 7, 8% inflation, you still have a Fed funds rate that's under 1%.
So from the Fed's perspective, the Fed is still well behind the curve.
You have to bring at least up to, let's say, 3, 4, 5%.
The Fed will be raising rates, no chance of a pause.
Hawkish path of the Fed is still most likely.
Yes, we're squarely in a slowdown.
We have made the turn on employment.
There's a lot of tightening priced in.
Inflation is so front and center.
This will do nothing to deter the Fed from where they're going.
That is the expectation for the Federal Reserve as we take a look at currently being priced into the market. Full 50 basis point rate hike, not only this month, but also next month and then in the September Fed meeting. JP Morgan's David Leibovitz was expecting it to be peak inflation a couple of months ago, yet here we are staring in the face of a new 40-year high. What did you make of this inflation read?
So the headline number obviously came in hotter than expected. You look at what drove that, and energy was a big part of the equation. And so, to us, we're really much more focused on the core figure. And I think if there is a silver lining to this, it was arguably the stability that we saw in core. In terms of the various components, I mean, the story here is still the same. You have food and energy contributing to elevated headline inflation. You have the big move that we've seen in home prices continuing to support the core figure. I think the core number probably would have been a smidge lower had we not seen that pop in auto prices. But, look, I think that the reality here is everybody knows that inflation is not going to be transitory. Everybody knows that inflation is going to be sticky. And I think the question that we need to be asking ourselves is, what does this inflation mean for purchasing power and consumption, particularly during the second half of this year?
Exactly where I wanted to go. Well, a lot of people were parsing between the numbers. You strip out energy, you strip out food, and you start to see it's everything else as well, whether it's airlines, whether it's cars, whether it's whatever else people are buying. We are seeing real wages continue to head further negative. They are not keeping pace with inflation where it is now, currently on a weekly basis, negative 3.9% in terms of real wage inflation, and that's the weakest going back in data to 2006. How much will that crimp consumer appetite, David?
So we think that it will. And, one interesting thing that we've observed in some of the data from the Chase side of our business is that there's already been a significant shift in spending, particularly amongst lower income individuals, away from discretionary items and back into core, right? They're spending more on food, they're spending more filling their cars, heating their homes, so on and so forth. This has also been reflected and highlighted in a number of retailer earnings reports over the past couple of weeks. And so I think what's going on here is you're going to see this shift in consumption. We know that the consumer is healthy. We know that the consumer has excess savings, which can allow them to withstand this food and energy and commodity shock more broadly, but they are beginning to shift what they are spending on. And I do think that that's going to lead not just growth to slow, but inflation to come off the boil here during the second half of this year. Again, that headline number is very noisy, given what's going on with energy prices, and anybody who drives a car knows exactly what's going on with energy prices. I think watching that core figure is going to be key for determining what the Fed is going to do, and we do think that that core figure could decelerate with a bit more pace during the second half than people may be thinking in the wake of this morning's report.
That headline figure is noisy. It's also what people are feeling with that new 40-year high for inflation. And even if the Fed eventually gets a sense of patience from that core CPI coming down, right now expectations are high that we are going to get 3 consecutive 50 basis point rate hikes. Michael McKee parsing through all of this. Mike, what are you seeing?
Well, Lisa, you got to go back to December 1981, as you said, to find the last time we were dealing with inflation this high. And remember, they've changed the calculation since then to make it come in a little bit lower. So 8.6% is definitely going to be considered bad news. And while you guys were just talking about the Fed looking at core inflation, for Joe Biden and the administration and the average American, it's headline that matters because it's gasoline and it is food. And gasoline prices were up 4.1% in May, 48.7% on an annual basis. And the bad news is in June, prices have gone even higher. Most states now over $5 a gallon. Food at home up 11.9% over the course of the year. Owner's equivalent rent, that's one that's really got to be watched because up 0.6%. That's higher than it has been. And that pushes up home prices 5.1%. They're a third of the CPI. And used cars, we thought they were going to go down. They didn't. And they're up 1.8%, 16%. Airfares, everybody knows, have been up. So the components that have been driving inflation haven't really gotten any better. We've broadened out a little bit, and that is kind of bad news. And what you look at when you see what's happening with gasoline is the percentage of what you're taking home, your paycheck, your earnings, your spending that is going to gasoline has risen to an 8-year high and will probably go up even higher than that when we get the June figures. But as far as the Fed is concerned, they're going to watch. The markets are repricing, as you said, now 50 basis points for the next 3 meetings, but there are 3 CPI reports ahead. So we shall see whether we see any relief at all in the coming months. It's hard to see it coming with gasoline given the seasonality, but at this point, the Fed can keep raising rates, but can they tame gasoline and food prices? That's one area they don't have much power over.
Mike, that's what a lot of people are pointing to. Thank you, that the Fed cannot drill for gas, or drill for oil or refine it into gas, and they cannot plant crops. Mohamed El-Erian was weighing in on the Fed's approach to taming inflation just yesterday. Take a listen.
Now it's about minimizing the mistake, and they're going to have to make a choice and stick to it. The worst thing is a flip-flopping Fed, a Fed that hikes rates and then pauses in September, then starts hiking again and then pauses again. That would just mean that stagflation would persist much longer than it needs to.
Others say we're already in a recession. That's the view from Bank of America's Michael Hartnett, writing the following: we're in technical recession, but just don't realize it. In short, inflation shock not over, rates shock just starting, growth shock coming, no release valve from peak in yields, bear market rally to consensus. David Leibovitz, still with us. Do you agree? Is that what you're seeing also, that the bear market rally is basically the consensus right now, which means that perhaps we are heading toward a bit of a more weakening situation?
So, I think what's so interesting about the current environment is that there's lots of bad news, and everybody knows what the bad news is, right? Inflation's elevated, gas prices are high. It looks like growth is decelerating with a bit more pace. We had a negative growth quarter to kick off the year. What's so interesting to me, though, is that when you look at what's going on in the economy, when we go through the airports, when we're in various cities seeing clients, things are buzzing. And so if there is stagflation, I don't really see the stag. And I frankly think that, this lower rate of growth, and we're not in the camp that the recession has already started. We think that risk is much more concentrated in 2023. But if growth has come under pressure, which arguably it has, this is what we need to see, right? This is what needs to happen in order for inflation to come in, because effectively inflation is economic sweat, right? You get inflation when an economy is running too hot. The economy was running too hot into the end of 2021. The deceleration that we're now seeing is going to help with the inflation problem. And so I'm inclined to start taking the other side of this trade. I do think that there are some false dawns in the equity market ahead of us, but I do think that more clarity from the Fed, which will come over the course of the next few months with those 3 CPI reports that Mike mentioned, more clarity from the Fed is what's needed for the equity market to find its footing and potentially resume an upward trend in the second half of this year.
How are you taking the other side, David? What exactly are you buying, given the fact that, frankly, the index has really defied some of the noise underneath at the specific security level?
So, the problem with the benchmarks here in the United States is that they're heavily weighted towards growth. And so go, the big mega cap tech names. That's what you're going to see from the S&P. We continue to be interested, and this is where we started the year, in those types of businesses, those sectors, those industries that have operating leverage. That tends to be more of a value trade. We like the industrials. We like the materials. We think, given what's going on with the energy sector, particularly with the lack of refining capacity and where the crack spread is today, that there's probably some juice left in that energy trade. And so, to us, the question isn't necessarily, do we run away from equities? The question today, and I think Jonathan Golub was saying this earlier on, the question today for us is, which equities do you own? Because even with a 10-year at 3%, that's not a rate of return that's going to be sufficient for most people to accomplish, their longer-term goals.
When we talk about margin compression and Target, some of the other retailers that have really highlighted how much and how quickly this is happening, have we accurately priced some of the earnings revisions downward that a lot of people are expecting in the second quarter, that we're expecting to get rolling out over the next few weeks, given the fact that, frankly, consumers cannot absorb all of the price increases, and they're grappling with higher gas prices, higher wages, and the like?
So I do think the idea that higher prices can continue to be passed on, we're getting to that breaking point. We always kind of remark internally that, look, the cure for higher prices is higher prices. And so obviously this inflation is beginning to weigh on demand. What I would say about the margin issue more specifically is, there are basically 3 things that you can do to defend your margins. You can pass on those higher prices, which is what we've seen so far this year. You can focus on productivity, anecdotally, which I think is going to begin to show up more across the various earnings reports. You saw a surge in investment spending coming into this year. Obviously, that's taken a pause, but automation and efficiency still front of mind for corporations. And then finally, there's the labor market angle. And, I wouldn't read too much into what happened with claims last week. We think that bounce was more a seasonal factor than anything else. But anecdotally, you hear about layoffs, you hear about hiring freezes. I do think that corporations are recognizing that the employment side of things may have been a little bit too far over its skis. You're seeing them begin to pull back. And really that cost management piece is something that we believe is underappreciated and may allow margins to prove more resilient than a lot of people are currently penciling in.
David Lebovitz, sticking with us. If you're just joining us now, we just are coming off a half hour ago. The hottest inflation read for consumer prices in the United States going back to the early 1980s, a 40-year high, as everything from gas and food, but also with rents and airlines, started to increase in terms of the pace of rate gains. Right now, with a look at some of the stocks that are getting most affected, here's Abigail Doolittle.
Well, Lisa, on this shock CPI report, we have stock futures down very sharply, down more than 1.5%. On the week, the S&P 500 E-mini futures on pace for the worst week since January, down nearly 4%. Not surprisingly, on this report and the massive flattening on the yield curve, all parts of the yield curve, in fact, the 530 inverting briefly, but it's that two-year yield that, as you know, backing up more than 10 basis points, weighing on big tech. Valuation fears down 1.9%. It's also interesting, though, you don't have the rest of the yield curve, or you don't have some of the other yields, they're flat. You have banks down even with the yield curve flattening, not surprisingly, down 2.1%. American Airlines, you were just mentioning that airline inflation down 2.3%. And then Target, they, of course, have had a tough time managing inventories. Inflation, a piece of that story. That big box retailer down 1.3%. A rough start to this morning for sure, Lisa.
Abigail, for sure. Thank you for keeping track of it. We'll keep checking in with you. Coming up, the Biden administration trying to tackle supply-side inflation in the face of what we just saw from the CPI report.
We were paying $3,500 a container in 2020. And then by September, October of last year, we were paying upwards of $20,000 to $25,000.
Yeah, it's outrageous.
Outrageous.
Pain at the ports adding pressure to already surging prices. That conversation still ahead. And as Abby was talking about, we are seeing stocks plunge in the face of higher and yet higher inflation in the United States. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
One of the big reasons why prices are going up is the cost of shipping things across the Pacific in particular. Major ocean line shipping companies who ship from Asia to the United States. These companies have raised their prices by as much as 1,000%. We've got to change this. We've got to bring down prices.
President Biden is scheduled to visit the busiest port in the country later today. This as the White House keeps a close eye on labor negotiations with dock workers. One trade group president saying a strike could, quote, certainly move us into recession in a matter of weeks. So the president has got to calculate this very carefully. Joining us now from the Port of Los Angeles is Bloomberg's Ed Ludlow. Ed, what do we actually see President Biden being able to do, not only about the labor situation, but really how much that bleeds out into the supply chain disruptions fueling some of this inflation?
Yeah, I think it's not a question of what is happening, but potentially what could happen. We care. The reason I'm here, the reason the president is coming on Inflation Day to the Port of Los Angeles is that an impasse between the Longshoremen and Warehouse Workers Union and the PMA, who operate the ports on the west coast of America, could lead to an impact of supply of containers. An impact to the supply of containers could raise prices. If you look into this Bloomberg terminal chart that I've got, we're down around 27% from September, when 40-foot container prices peaked due to inefficiency here at the port. And the president's response was to say to Labor Secretary Walsh, Transport Secretary Buttigieg, you two need to get there on the ground and get this situation resolved, not just in terms of the talks between the unions and the operators, but also to help in easing the supply chain concerns that we see. That's the chart you're looking at on your screen now. We note that in the inflation print, we are talking about rent, food, gas prices, and those are slightly separate to consumer goods. But the other thing that's happening around the world, of course, Lisa, is that China's economy is reopening, and that there has not been a flow of goods coming into this port in the same way, perhaps, that we saw between September and the first 3 months of this year. So they are bracing for higher volumes, particularly in the month of June, where retailers here in America take very proactive stances to look at inventories ahead of the holiday season at the end of 2022.
Ed Ludlow, thank you so much for your great reporting there, and catch Ed's interview with the executive director of the Port of Los Angeles coming up at the top of the hour. A key issue as we grapple with many inputs to this inflation backdrop. On that point, Henrietta Trey's joining us of Veda Partners alongside David Leibovitz of JP Morgan. Henrietta, how much can, frankly, this administration or anyone in the political sphere do to offset some of these inflationary pressures, considering how multifaceted they are?
Well, I think there are a couple of things. Just to stick with the port issue while we're on it at the moment, if there's one administration with a built-up well of goodwill from labor that can negotiate the upcoming issue that we're going to see in July, it's the Biden administration. You know, the president is there right now, but more importantly, I would say Ambassador Tai was there from the U.S. Trade Representative office earlier this week at the Summit of Americas, but we've seen their focus on labor negotiations in the past with the Supply Chain Crisis Council that they convened last year that linked workers with the ports, with the big box retailers. They have a residual well of goodwill that I think diminishes my anxiety internally about whether those labor negotiations will blow up. I think if anybody's administration can handle it, their focus on labor in the past couple of months strongly makes an argument for this being resolved well in advance of the uptick in China port containers coming over. On the other side, in terms of what the administration can do on inflation, obviously that's not in the hands of Congress or the White House. But they do have a bill that is rapidly gaining traction. We'll see if it can come to fruition. We tell our clients it's a 50-60% odd situation at best right now, but it's targeting the tangential pieces of inflation, which is going to be not providing domestic stimulus to individuals through things like the child tax credit or the earned income tax credit right now, but things like domestic alternative energy sources, providing funding to those, trying to tamp down domestic household healthcare costs, prescription drug pricing. So as we see inflation continue to ripple through the economy and wreak havoc, and you're seeing wages actually come down in this last month's print, you can do things tangentially to offset household costs. I think that's where they'll focus.
And David, this really speaks to the question that you were talking about, the expectation that we will see inflation start to roll over, at least on a core level, when you strip out energy, when you strip out food, because of some of these areas that are softening a little bit in the good way. However, firms are still anticipating squeezed margins. Morgan Stanley had a global supply chain survey talking about the fact that on average, corporates expect margin declines of about 2% due to supply chain changes. U.S. companies were more inclined to consider onshoring, others in Europe and Asia more likely nearshoring. How much is this a persistent headwind to margins? This idea that it's not just the inflation, it's also structural changes that have come about as a result of where we are right now.
So the supply chain issue is obviously a very interesting one. And I keep reminding people, you know, companies were rethinking what their supply chains looked like before COVID. We were in the midst of a trade war with China in the run-up to the pandemic, and you already saw corporations beginning to take action to relocate and diversify their supply chains globally. You know, when we think about this issue of is it deglobalization, is it slowbalization, we're much more in the camp of slowbalization. We think that businesses are going to be more thoughtful about where their supply chains are located, where they're doing business. It's not necessarily going to be about seeking out that lowest cost of labor and production, but the idea that this whole thing gets completely thrown into reverse to us is just a bit of a stretch. And you know, the other point that I think it's important to recognize is a lot of our conversation this morning has centered on the supply side of the economy. You know, we've talked a little bit about demand, and this is what makes the inflation thing so challenging is higher rates don't fix the supply chain. Higher rates don't bring workers back into the labor market. Higher rates weigh on things like housing, and you've already begun to see that play out. And so the question for me, as we think about the Fed, which is really in the driver's seat here, is can they differentiate between the inflation they're able to control and the inflation that they are unable to control? Because if they fail to differentiate between the two, that's, in our view, what could potentially crash the plane at some point in 2023.
David Leibovitz, we all hope that they manage a soft landing, frankly, because of what we're seeing around us of JP Morgan. Henrietta Treyz of Veda Partners, thank you both so much for taking the time. Coming up, the morning calls and later big tech under pressure after U.S. inflation accelerates to a fresh 40-year high. That conversation still ahead. We are seeing those declines deepen throughout markets, not just the big tech names after as hotter than expected inflation read boosted expectations for Fed rate hikes. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
This is Bloomberg Markets, the open, taking a look at losses deepening throughout the morning after a hotter than expected inflation read led by big tech. Time now for our morning calls. I'll look at some of the analyst recommendations on Wall Street this morning. First up, MoffettNathanson downgrading Electronic Arts to neutral, $147 price target, seeing limited upside following the stock's recent rally. Next up, Goldman Sachs downgrading Netflix to sell, $186 price target, expecting a weaker macro environment on consumer spending. And finally, JP Morgan upgrading Spirit Airlines to overweight, talking about a tactical trade idea on growing M&A hopes. Coming up, we get the market open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, and that sell-off is persistent. NASDAQ leading the way down, was down as much as 2% and beyond. Now down 1.9%. We can see the S&P down 1.7%, 39.48. We have gone below that 4% level. Meanwhile, if you take a look at the bond market, that is what is driving the action. We are seeing two-year yields surge to the highest levels going back to 2018. That's leading the way. We are not seeing the same kind of gains in the yield, loss in the price of the longer end. That flattening yield curve is really signaling the concern about growth, also signaled by crude falling to 120 basis points. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle.
Well, Lisa, on this brutal action here on this shock CPI report, we do have stocks plunging, as you were just pointing out. In fact, the S&P 500 on pace for its worst week since the end of January, down about that 4%. This, of course, on these rising inflation fears, a fresh 40-year hit. This, of course, is hitting big tech because it means valuation is in concern. But you were mentioning the yield curve. It is flattening. In fact, the 530s were inverted briefly. The two 10s are below 10 basis points. That's weighing on the banks. Big banks down in a big way, down more than 2%. United Airlines and other airlines down sharply on inflation fears, price increases, and what will that mean for the future. And then, of course, we've had some of the big box retailers. Target is down sharply, but Walmart is also down sharply. These companies have a hard time managing their inventories amidst these inflation fears. A rough start here for stocks, Lisa.
Abigail, thank you so much. A hotter than expected inflation print. Also taking the bite out of the tech sector. Bloomberg's Taylor Riggs joining us now with more. Taylor.
Yeah, and Lisa, I think what's interesting is Abigail was talking about the tech sector. We're also going to fold that into some of the discretionary, right? It is all about that high CPI data. Goldman Sachs out with a few calls this morning that are really interesting. One that you mentioned, Lisa, in your top calls when it comes to Netflix. We're taking a look at Goldman lowering price targets on companies like Airbnb, cutting Netflix, Roblox, eBay, right? All on sort of macro concerns when you think about tech, but you also think about the consumer-facing technology companies, right, in the midst of this higher CPI data. I think what is so interesting is take a look at year to date. We always thought that sort of the consumer staples was this big defensive play, and indeed, the discretionary at the bottom of your screen, that's off now 28%. When you think about how consumers are going to cut, where they're going to cut, what is really defensive in this environment, what is not. So it really has been that discretionary at the bottom of the screen that continues to be hit the hardest when we think about some of the higher inflationary costs that are underway. Flip up the board, and well, there's no better chart to show this than sort of the relative outperformance of how we're thinking about staples, how we're thinking about consumer discretionary, and that is really all of sort of these fintech stocks. And then, of course, if you want to pull up the terminal chart that we have there, all about the consumer defensive. And Lisa, certainly that story continues today.
Taylor Riggs, thank you so much. Strategists growing concerned about the outlook for corporate profits, C-suite confidence tumbling to a 6-year low amid surging inflation and tightening margins. Kaylee Lyons joining us now with growing earnings recession fears. Kaylee.
Yeah, Lisa, typically when you see confidence rolling over like this, it indicates that profits are going to take a hit about 3 to 6 months out. And of course, it's not just CEOs that are sounding the warning. Analysts are too, in that they are cutting their earnings estimates. We are seeing those earnings revisions moving lower. The Citi Global Earnings Revision Index actually has been in negative territory pretty much since March. And of course, the revisions have been more dramatic for certain groups of stocks, like growth stocks, the kind that Taylor was just talking about, which have been underperforming due to higher rates and inflationary pressure. Bloomberg Intelligence says that actually since mid-April, growth stock earnings estimates have slid by 7 percentage points for the second quarter. And they've been cut for the second half as well, down to just 3.2% in the third quarter and 4% in the fourth. And of course, all of this as profits are under pressure, in part due to the burn of a stronger dollar. That's what we heard Microsoft talking about recently. It's significant when 40% of S&P revenues come from overseas. But more broadly, it is the inflation problem. Once again, on display today, companies facing higher costs on everything from raw materials to freight to labor. And you put that all together with a consumer that maybe is starting to change its behavior in the face of these persistently high inflation pressures, and the ability to pass those costs on gets harder. So it raises the question of, if we haven't seen peak inflation, Lisa, does that mean that we have seen peak profit margins?
Kaylee Lyons, thank you so much. And you start to see some of the warnings on a strong dollar, typically when other things also are not going perfectly well. Dan Skelly knows as well of Morgan Stanley, heading their equity modeling portfolio for them there. You guys have nailed it when it comes to the rate fears turning into a slowing growth fear kind of environment, which is very much where we seem to be. How does what we just saw, the CPI print, play into that narrative?
Good morning, Lisa, and happy Friday, and I'll add happy summer to you as well on this volatile Friday. A few things to note. So this is actually really consistent with what we've been saying for the last 6 or 7 months, as you know, and we were, a bit lonelier at the end of last year, signaling a more cautious view, but our view on inflation, which was out of consensus and cautious a year ago, was also what informed us in terms of our defensiveness related to the market. And when you talk about the market, several of your guests have already highlighted it this morning, the size of tech and the size of growth in the market is obviously historic, and they also happen to be the cohort most susceptible to higher interest rates and higher inflation. So all of these calls were connected. And so frankly, what we're seeing this morning is just more confirmation of some of the caution that we had originally.
Dan, based on the components factoring into CPI, do you think that we've seen peak inflation?
I think what made me particularly cautious that we have not is some of the services data. So when you look at it, it's a dual-edged sword, as we know. I think COVID was a particularly unique recession in that many of the wealthier cohorts of the income scale did better. Frankly, they didn't lose work. They made tremendous gains for several years in the market recently until, this year. They've made tremendous money on home equity appreciation. And so they have tremendous pent-up demand to go out and travel. I'm very sympathetic to some of those travel comments earlier today as well. And so, I think when you see hotel, airline, medical costs, and some of these services, call it stickier costs going higher, perhaps we're going to be in this for a little bit longer, Lisa.
Famed investor Stan Druckenmiller was saying yesterday that the bear market has more room to run, saying, continue, that my best case is that we're 6 months into a bear market. For those tactically trading, it's possible the first leg of that has ended, but I think it's highly, highly probable that the bear market has a ways to run. Dan, I get the sense you agree with him, but how much? How do we gauge the scope of pain given the revisions upward of inflation and downward of growth?
Excellent question, Lisa, and this is really the key topic today. And, as we've outlined it, and Mike Wilson, our strategist, had outlined it, correctly, the first part of the bear was this inflation and rates and derating in the multiple. And we've seen that play out. Multiples in the S&P are off 20% or so year to date. The second part of it, in our view, is the earnings hit, okay? And so we have seen, obviously, some blow-ups in some of those most acutely sensitive to over-earning in the COVID period. So the retailers of the world who over-ordered inventory and maybe have a little bit of skew to that lower-end income scale, who's getting particularly impacted by food and gas today. So we've seen that. We think that that basically broadens out a bit more to some other parts of the market. That being said, okay, we see this being limited to a multiple and earnings hit. We do not see a part 3 just yet of a broader economic hit. So, Lisa, to answer your question, yes, there's probably a volatile summer ahead of us, but we still don't see an economic contraction. And with that, you're probably going to be limited to maybe 5–10% further downside.
So when we talk about no recession or necessarily a hard landing, how does that feed into the Fed call here? Because right now, the market's pricing in 2 more 50 basis point rate hikes at the consecutive meetings coming up for the Fed. And yes, they can't solve issues with drilling for oil or with planting more crops, but they can dampen demand. Where does that fall into this sort of softer outlook of yours?
So it's a super complex topic, and the way I would answer it, and I'll add to that, by the way, everyone's been talking about the Fed can't build a refinery, the Fed can't control the Chinese lockdowns. I'll also just add the Fed can't go down to Florida, knock on people's doors who retired the last 2 years and tell them to come back to work, right? We're dealing with many structural issues here at the moment. How does this all feed into our kind of softer landing, non-recessionary call, Lisa? We have to differentiate between the markets and the economy, right? And so when you think about it, a lot of the time they are related, but there are times where they diverge. And this is one of those times. We're going through this tremendously unique experience of removing unprecedented stimulus, emergency stimulus, right? And so that was never going to be easy. We haven't also, by the way, talked about as much QT, which is just starting really in earnest this month. The maturity roll-off really does accelerate towards the second half of June. So you're going to continue to see this market volatility. You're going to continue, we think, starting in July and maybe even extending to September. You're going to see earnings pressure on the cost side of things. On the dollar side of things, look at the dollar moving. This morning, you heard from a huge software component a few weeks back about their dollar impact. I believe Kaylee, referenced earlier the 40% of S&P from overseas. So it's more of a market event versus an economic event at this time.
Do you really buy that? People always start to warn about currency issues when everything else is falling out of bed as well. I mean, don't you think that part of this is a slowing growth story globally that's feeding into a lack of demand, and not just simply the dollar as a reflection of that?
So in terms of tech, I think they're unique in that, look, they've suffered the most, as we've talked about, because they're the most sensitive to rates. And so on the multiple side of things, yes, they've suffered. I would argue, however, Lisa, and I see companies and listen to companies all the time. I saw a dozen companies last week at a conference. The demand for tech spending, the services, the cloud, connectivity, mobile, digital transformation, look, all of these things accelerated because of COVID. They were massively in demand before COVID, but if you were an industry or you were a company not prepared for a digital future, I bet you're investing heavily there too. And David, your earlier guest mentioned that as well in terms of the capital spend. So listen, I think it's going to be unique on an industry by industry basis, but I do think the tech earnings demand may be more resilient.
Where do you see earnings pressure not fully priced in? Which sectors of the market?
Listen, I think there's probably some room to go further down on the industrial side of things, right? So when you think about what's going on in Europe, what's going on in China, Asia at the moment, you know, and think about some of the pressures there, I think industrials and PMIs, frankly, have further to fall. Okay, so that's one area we would think about. Look, in terms of the defensive sectors that have worked, you've seen that kind of classic rotation to date in terms of utilities, healthcare, some REIT outperformance. The one area Mike and team has been a little bit more cautious on is staples. And so they are dealing, frankly, with the inflationary pressures probably most. Yeah. So that's another area, Lisa, where there's probably going to be more surprises in staples land this coming quarter.
To that point, 18 minutes away, the University of Michigan U.S. Consumer Confidence Survey. How important is that in determining your bullish or bearishness about consumer staples, about some of these more sensitive sectors?
You know, I think sentiment has been really dirt poor for the last couple of months, and it probably will continue to be that way, just given the inflation pressures, as we've alluded to, aren't going away anytime soon. You know, some of your guests have commented on pricing power, and to date, we've seen companies getting creative not only on pricing but also on packaging. And I, you know, certainly can detect some changes in some of the everyday goods and items that I certainly utilize, and maybe you have as well. And so they're trying to do every type of creative financial engineering measure to manage the bottom line. The question is, how long is that going to go on for? We continue to favor, from the equity standpoint, we continue to favor those global franchises with pricing, with brand equity, that are, frankly, winning share in this environment. And I'll just say one last thing, that are using technology and analytics to become more efficient. That was a trend going on before COVID. Like we've talked about, that continues to be incredibly paramount importance.
Dan Skelly of Morgan Stanley, thank you so much for being with us. Coming up, U.S. inflation surging to a 40-year high, adding yet another headwind to the airline sector. That conversation coming up next as we see those losses continue to deepen. The S&P down 1.8%, 39.45. This is Bloomberg.
Estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pricing is way up, demand has outstripped supply, and that has allowed prices to stay high. And, you know, are there going to be cracks? Are there going to be places perhaps where things start to, you know, reach their peak or come off their peak? Sure. But broadly, we're not seeing, you know, any discernible moment or timeline where it's like, oops, you know, come whenever, it's all going to fall off.
The Expedia CEO speaking about how inflation in America, which just hit a fresh 40-year high, is really crimping some of the consumer spending. Another confirmation of surging prices, turning up the heat on the Fed's rate hike path. For more, let's bring in Bloomberg's Michael McKee. Mike.
Good morning, Lisa. Yes, you have to go back to December 1981. The Grinch came down the chimney and brought inflation as high as it is now. That was the last time we saw anything like this. If there is a bit of good news, it's in the contained rise, only 6% in the core rate. And that's something we'll have to keep an eye on because, once again, food and fuel prices really drove the index higher. Gasoline prices up by almost 49% on a year-over-year basis. You don't have to tell anyone who's filled up their car lately that that's an issue. Home prices also are an issue. We've known that they come into the CPI slowly, and they're starting to pick up, and we have seen a big run-up in home prices. The question now is, with the Fed raising interest rates and mortgage rates going up so much and home sales dropping, will prices drop or will they stay firm? That's going to be something that they're going to be watching in the future. A couple other surprises in the numbers today. Used car prices, people thought they'd go down and they didn't. And then airfares. This comes out of COVID. And remember COVID and its impact on the economy? The airlines are making up for lost time with airplanes packed and not enough crew because they had to let so many people go during COVID and people still getting sick. So airfares up again on the month. They're up 37, 38% for the year. Now, one would expect that to start dropping, but it hasn't yet. Of course, we're in peak travel season now, so we'll keep an eye on that going forward.
Michael McKee, thank you so much. Some shocking statistics about how much airfare has gone up. Pricing spiking nearly 13% in May alone, not to mention the 38% year-over-year gain. Cowen's Helene Becker joins us now to discuss the airline industry, and this comes as we get a headline right now. Before we get to the inflation aspect, the CDC is planning to lift test requirements for travelers entering the U.S. This is being reported by CNN, and that you're seeing a reaction in markets for a lot of travel stocks. How big of a deal would this be for the travel industry, Helene?
Hi, Lisa. Yes, it's huge for the industry. We and others have been urging the White House to eliminate pre-departure testing for the better part of 3 or 4 months. We're the only country left to do it. There are workarounds. People are flying to Toronto, they're flying to Tijuana, and then they're walking across the land border because you don't have to test if you drive across. the border only if you fly. So it's gotten insane. And given the workarounds, it's about time this happened. And we think it's going to have huge positive effects on international travel right into the fall, which brings up your other point.
Right. Well, that's exactly where I wanted to go, Helene. I mean, basically, you could argue, do we really need that much more demand if the sky is the limit when it comes to how high airline tickets can go? Capacity isn't increasing and airlines are getting filled up everywhere they go. Helene, at what point do we start to see some of the price increase cool off?
Yeah, that's such a good question. I was at a dinner a couple of nights ago in Chicago, and I was talking to a couple of airline CEOs who were also there. And our concern has been that demand destruction will occur after Labor Day when people realize how expensive things are and they kind of run up against budgetary considerations. And to a person, they said they're not seeing any signs of weakness in travel or any pushback on price, which I find a little difficult to believe, especially because Southwest has had a 3-day fare sale going on. I think today is the last day of 40% off fares for the fall. So that says to me there's a little bit of concern. They may not be willing to admit to it yet, but I think it's out there. And so we're a little worried. Go ahead.
Just real quickly here, Helene, how much of this is being driven by business travel, people getting back out to conferences, a shift away from simply leisure and discretionary spending?
I think that's what we have to see now. And yes, I think that we are starting to see that business travel improve sequentially, especially as people return to office. Being in the airports the last 2 days, they're packed, and it's a combination of leisure, but a lot of business people, a lot of suits, which, I thought kind of went away, but no, people were dressed and clearly they're working. So I think to your point that conferences are driving demand is certainly there, and we expect that to continue. But to your earlier point, I don't know where we're going to put all these people. It's wall-to-wall people in the airports. The planes are packed. The demand is really high. We don't have capacity, and yet every airline manager will tell you we're still not back to 2019 revenues. So they think there's room to go to the upside, and we'll see.
Helene Becker, thank you so much, as always, for joining us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary as we look at markets. Pummeled by a hotter-than-expected inflation read, NASDAQ getting absolutely hammered, down 2.4%. A regain in that relationship where tech stocks are losing more than the rest of the market, considering their rate sensitivity. From New York, this is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that Communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Less than a half an hour into the trading session, and the losses are deepening as markets digest that hotter than expected inflation rate coming in at the hottest level going back 40 years. The losses are particularly acute in the NASDAQ, down 2.5%, whereas the S&P down 2%, driven by the front end of the yield curve. You can see two-year yields surging on the heels of this report, almost to 3%. Time now for the trading diary, what you need to be watching through the next week. Michigan's Consumer Sentiment Survey coming at the top of the hour. President Biden addressing inflation in America from the Port of Los Angeles at 1:45 Eastern. U.S. PPI on the calendar next Tuesday, followed by a trifecta of central bank rate decisions. First, the Fed and Chair Powell news conference on Wednesday, the Bank of England on Thursday, and finally wrapping up the week with the Bank of Japan on Friday. This was the Countdown to the Open. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of Lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend